regarding the treasury operation flowchart, as you can see. So friends, here we decode the entire structure through a simple, easy to understand flowchart. Let's begin with the treasury structure. As you can see here, let's begin with the treasury structure. So friends, which is broadly divided into basically three main areas are there: front office, back office, and mid office. Right. So mid office I will talk about in the latter part of this video. So what happened in the front office? Let me explain what happened in the front office. So front office is like action zone. We can call the front office as the action zone. That means where interbank deals are executed. You can see it execute the interbank deals, first point. And whether it is forex, whether it is securities, lending or borrowing, right? Think of it like a command center where actual trading magic happen. So you can think of this forex as command center, right? And where the actual trading magic happen. Further from here, two key functions unfold. What are the two key functions? The first is the execution of the deal, which means the deal initiated are put into action. So whatever deal you have initiated, that is put into action here. That is called execution of deal. And the second is called team structure. Every great system need a stronger team, right? This includes chief dealer. Chief dealer is a part of front office who lead the charge, and a specialized dealer who focus on a specific market segment, right? So these are the two different team structure under the front office. You must know it, that it consists of chief dealer who lead the part, and there are specialized dealer. Next come managing the treasury book. Here you can see how can we manage the treasury book. So friends, all executed deals are recorded and managed properly in the treasury book to track performance and risk exposure, right? So this management give rise to two types of books. Two types of books are basically there, right? The first is called the trading book. You know what is the meaning of trading book? So it deals done on the bank on behalf. So those deals which are done on bank on behalf, that is called trading book. That is called trading book. Deal which is done on bank on behalf, that is called trading book, right? Aimed at earning profit. What is the main aim? Main aim is the earning profit, earn profit. That is the main aim, right? The next we have is called merchant book. Merchant book means what? Deal executed on the behalf of clients, and it is based on internal requirement. So basically trading book means what? Deal done, right, on the bank on behalf, and it is aimed at earning profit. While merchant book means what? The deal executed on the behalf of clients, right, and this is based on the internal requirement. So that is all about the front office which you have to know, right? Execution of deal, team structure, treasury book management, whether it is trading book, whether it is merchant book, right? What trading book store, what merchant book store. Now friends, let's move to the back office. At the bottom you will see, right, back office. So back office is called silent powerhouse. In single word you can say they are like silent powerhouse. Why we call them silent powerhouse? Let me explain. See, this system ensure that all the deals are confirmed and settled within the bank approved exposure limit. You see, all the deals, whatever deals is there, they are confirmed and they are settled within the bank approved exposure limit. So they also handle the rate verification to check the deal accuracy. Yes, to check the deal accuracy, how much accurate the deal is, they also undergo the rate verification. Furthermore, compliance responsibility. They ensure that everything aligns with the internal and the regulatory norm. That is called compliance responsibility. So in nutshell, we can say that front office execute and manage the deal, while the back office confirm, back office settle, back office ensure that compliance. So together they form the core of the bank treasury operation, right? And furthermore, we have mid office also. In addition to the front office and back office, we are going to talk about in the latter part of this video. Now friends, let's come back to this particular flowchart diagram. This will help you remember the things for a longer amount of time, and once you solve MCQs based on them, you will feel confident. So friends, let's dive into a critical control mechanism in forex trading, that is called FX trading limit. Yes, we are talking about what? We are talking about FX trading limit, right? Their objective, their types. First thing first, why do we need trading limit, right? So what is the objective of them? See, the core objective is to limit potential loss. That is our main objective, that to limit the loss, limit the potential loss during the adverse market condition. Yes, so the main objective is to limit the loss during adverse market condition. You can think of them like protective shield. Yes, they are like protective shield. Why I call it protective shield? Because this is the one that ensures that bank does not go off the rail when the market gets rough. When the market gets rough, bank does not go off the rail. This is what is ensured by forex trading limit. If you look at the types of forex trading limit, on one side we have open position limit. What is the meaning of open position limit? See, they restrict the volume of open currency position a dealer can hold at any time. As the name itself suggests, right? Open position limit. That means they put a restriction. They put a restriction on the amount of open currency position a dealer can hold at any time. That is called open position limit. Furthermore, we have called a stop loss limit, which means the emergency break. We can call them like emergency break. We will talk in detail about this. We can call them emergency break, right? If the loss reach a predefined point, this position is exited automatically to cap further loss. And then we have something called deal size limit, which means it set a ceiling on the size of individual trade. That means it set a ceiling, it set a cap on the size of the individual trade, right? On the size of individual trade, it put a ceiling. But remember, this is mainly for proprietary deal. Remember, this deal size limit is mainly for proprietary deal, not for covered merchant deal, right? If you look at the open position concept here in the right side, you see, and you can see. So what is the meaning of open position? This refers to a situation where a bank hold a currency position open. So see, suppose the bank hold a currency position open, right? Means why? Expecting to gain from the forex movement. Yes, bank is expecting that it will gain from the forex movement. That is why bank keep its position open. That is called open position limit. But it comes with the onset of risk. Obviously, the risks are there, right? Bank have to keep the open position. Why? The bank has kept the open position expecting to gain from forex movement, expecting the forex gain. But yes, there are some risk also in this case, like market may not appreciate as expected. You can see the first risk is no appreciation, the second risk is it carry cost, and the third risk is the rupee fund cost all add up. Now friends, then we have something called, so we have discussed the open position, now discuss the forex position. So whenever you see the open position, just remember this key point, that bank hold a currency position open expecting to gain from the forex movement. If you look at the forward position, this involves future forex commitment. Remember, it involves future forex commitment, right? That is called forward position. So two major factor comes into play. The first is called position sizing. What is the meaning of position sizing? Means how much exposure should be taken. And the second is called currency anticipation, which means what direction will the currency take. So remember, forex forward position regarding future forex commitment, and two major things are there: position sizing, which means how much exposure should be taken, and currency anticipation, which means what direction will the currency take. So to summarize, these FX trading limit are not just compliance tool, they are the bank safety net, balancing profit potential with the risk control, a must known for anyone serious about forex treasury. I hope we have discussed the major kind of forex trading limit in this particular slide. If you really think that it was useful for your understanding, please hit that like button. Now friends, let's move to the overview of the financial position management. So let's decode a financial position management framework, a crucial system that keeps a bank forex and treasury exposure in check when within regulatory comfort zone. First of all, types of the position limit. Let me zoom a little bit so that this picture become clear. First of all, let's talk about the types of position limit. To begin with, bank operate under position limit. Yes, both currency wise as well as aggregate INR term. So see, currency wise also there are position limit, and aggregate INR there is also position limit, right? For example, if a bank is dealing in USD INR, the net position is closely monitored, right? If suppose bank is dealing in USD INR, the net position is closely monitored, right? And if there is any overnight position, try to understand, if there is any overnight exposure, let me write down, if there is any overnight exposure, what will happen? In that case, that require prior approval from RBI. RBI nod is required, right? That is called, if there is any, right? If there is so basically we are talking about the types of position limit. Bank is dealing in USD INR, the net position is closely monitored. Any overnight exposure, then what? That require prior approval from the RBI for overnight limit. Now, if you look at the position limit, just I told you currency limits are there and aggregate limits are there, right? And RBI nod is required. If you look at how to measure the position limit, these limits are not random. They are measured meticulously, again in INR value, covering both individual currency and the overall position, right? That is the point. Net position are tracked continuously, right? They are tracked continuously. And regulatory nods are must for extended exposure. If you want to extend the exposure, you need to get a nod from RBI. If you look at the swap deal risk, here you can see What is the meaning of swap deal? See, here is where the things get interesting. If a bank buy in a spot market and sell in forward market, it technically avoid forex exchange risk, because it is buying in the spot market and selling in the forward market. So basically it is technically what it is doing, it is avoiding the foreign exchange risk, right? But there is a catch. What is the catch? The catch is that the interest rate gap risk. This is where time gap comes crucial. The longer the gap, the higher the risk. Obviously it is not exposed to foreign exchange risk, but yes, it is exposed to interest rate gap risk. The higher the difference, the higher the time gap between buying and selling, the higher the time gap, right, the higher the risk. That is interest rate gap risk. So you can see that this swap deal risk is not just like that, it is no risk is there. Yes, risk is there. The risk is interest rate gap risk is there. Now there is a concept called gap limit concept. What it is? See, gap limit apply to time bucket. We have already discussed time bucket in the earlier part of the lecture, right, in the previous lecture. So what is the meaning of gap limit? So whenever you see this word gap limit, basically it applies to what? It applies to time bucket, right? It applies to time bucket. So say overnight, 1 to 7 days, etc. So positions are revalued daily basis or monthly basis, and bank must make sure that their AGL, what is the meaning of AGL? AGL means average gap limit. So their AGL, or the average gap limit, stay within a cap, which is how much? Which is linked to their capital base. That is called average gap limit, right? That is called gap limit concept. I told you now that if gap limit increase, then obviously it is exposed to interest rate gap risk. So to curtail that, to avoid that, right, AGL has been placed, which is maximum 6 times the capital base, right? This question is frequently asked. What is AGL? Average gap limit. Now one more thing, capital requirement. See, here is the golden rule. Bank must maintain 9% capital buffer. It must maintain 9% capital buffer. But on what? See, on what? Either on their NOPL. What is NOPL? That is called net open overnight position limit. So this question is most frequently asked. Net open. We are covering only that much which is important from examination point of view. I have seen the last 5-year paper. Based on that analysis, I am providing you the content. So net open overnight position limit, that is called NOPL. Full form must be known to you. Net open overnight position limit. So bank must maintain 9% capital buffer either on their NOPL or the balance sheet date position, either of both of them, NOPL or balance sheet date position, whichever is higher. Whichever is higher, they should make 9% of that. Then look at the control in securities trading. So it does not end with forex. Even security trading is tightly controlled. Yes, it does not end with forex. Security trading is tightly controlled. Bank follow a strict limit based on deal size, maximum security, number of security, holding period, right, credit rating, bond maturity, and everything else. So these checks keep a speculative risk under control and ensure portfolio stability. So to conclude, financial position management is like the bank health monitor. It ensures that no trade, no swap, and no position spiral out of the control. Risk is real, but with the right limit, it is manageable, right? So that is the point which we have just studied now. So friends, what we have discussed just now, this was regarding the overview of the financial position management, right? So we have talked about the how many position limits are there, how to measure them, what is swap deal risk, what is gap limit concept, how to measure the capital, and how to control, what are the control in security trading. Now let's understand stop loss limit. In this particular slide, everything will be clear regarding the stop loss limit. So friends, let's dive into one of the most crucial risk control tool in trading, that is called a stop loss limit. You can think of it like safety net. It protects you when the market turns against you. What is the mechanism? So you can see mechanism. So stop loss is a kind of preset limit, right? It is a kind of preset limit. For example, imagine a trade hit $5,000, right, loss. Suppose a trade hit $5,000 loss. That is the threshold. At that point, mandatory exit is triggered. At that point, what happened? Exit is triggered. Mandatory exit is triggered. It is considered a management violation, and the action follow first, right? And if it not followed, try to understand. If it is not followed, so suppose the trade hit $5,000 loss. That is the threshold. That is the stop loss limit. At that point, mandatory exit should be done. If it is not followed, then what will happen? Then management violation and action follow fast. That is the point. I hope that makes sense to you. Now, if you look at the monitoring responsibility, that means who watches the limit. So here is the internal control at work, right? Internal control. So basically, the back office in charge of. It is in charge of the back office. So back office is in charge of tracking the stop loss trigger, valuing the position, alerting the front office. This act like second layer of check to ensure that nothing slips through the crack. Then we have something called multi-level framework, which means stop loss is not just a one-time rule, rather it is structured at multiple level, per deal, per day, per month, and even an annual aggregate, which means this ensures that risks are controlled at every step, micro level as well as macro level. I hope every aspect we are taken care of in this particular slide. That is the beauty of this our crash course, that you are able to cover the entire unit in just 20 to 30 minutes, right? There's no long boring lecture which takes more than your time, right? Our main focus is on solving MCQs. That is why 80% of your time should be devoted to solving MCQs and just 20% to this. Now friends, let's look at the application in security trading. Every aspect we have which you will see in book 2 to 3 pages have been covered in just single page. If you look at the application in the security trading, so when you are trading volatile or illiquid asset, volatile or illiquid asset, whenever you are trading, the need for a stop loss become ever more intense. Yes, if you are trading volatile or illiquid asset, the need for a stop loss become very intense, right? Very much required. Why? Because risk is monitored using some tools like MTM, mark to market, value at risk, duration analysis. These are the tools through which risk are monitored. Now what is the purpose of it? What is the purpose of a stop loss? Because it is simple. It's your last time line of defense. You can call it line of defense, right? It caps your potential loss, right? It caps your potential loss. That is the first thing that it do. Or the other thing that it do, it avoid emotionally driven holding on to bad trade. Yes, it avoid you holding position which is a bad trade. Think of it like emergency brake in a high speed trade. And if you look at the trader psychology versus risk management, so let's face it, traders are human, but emotions should not rule its decision. A stop loss force discipline. Hit the limit, say rupees $5,000, say $5,000, you must exit. No excuse. If you don't, strict management action is enforced. That is how risk is kept in check. And if you look at the valuation requirement, so lastly, for a stop loss to work, position must be marked to mark daily. This is very, very important, right? Only then can limit be accurately enforced in real time. So position must be marked to market daily. Only then this limit can be accurately be enforced in real time. So to remember, a stop loss is not about avoiding risk. It's about managing it smartly. It is not a trading tool. Rather, it is a discipline enforcer, a risk barrier, and your profit protector. Remember this. These are the keywords regarding the stop loss limit. You need not need to remember anything extra other than this. Now friends, let's switch our attention to the next topic, right? Let's dive into managing credit and settlement risk in treasury, right? So friends, how do bank manage credit and settlement risk using exposure ceiling limit? Let's understand. So it might sound technical, but don't worry, I have got you covered in all the simplest way. The first thing we have is called fixing the exposure limit, which means exposure limit are set to cap the risk for bank, financial institution, mutual fund, primary dealer, and forex and security broker. In short, any party your treasury deals with must have a well-defined exposure cap, right? So any party your treasury deals with, it must have a exposure cap. That is the point. Second thing is types of credit risk. Then look at it, very, very important. So credit risk is not one-dimensional. Rather, it includes default risk. Default risk is one part of the credit risk, which means the borrower bank might fall, right? Another kind of credit risk is called price risk. You see this price risk. Price risk means what? For example, repo. Let's take the real case of repo. So repo, repo might carry risk if the price drop, right? Weak bank have failed before. So treasury team avoid concentrated lending and spread the risk smartly. Yes, concentration risk should be avoided, right? We should spread the risk. Then comes the settlement risk. Yes, settlement risk is also very, very important part. Let me show you where it is written. Here you can see on the right side. This is what we are talking about, settlement risk. So friends, even if party does not default, the deal might still go wrong due to, right? Suppose party is not defaulting, but even then also the deal may go wrong. Why? Because delayed delivery or payment. This is called DVP, delayed DVP. This is called settlement risk. What is the meaning of DVP? Delivery versus payment is ideal, but not always possible. Second thing is government security, GSEC. So GSEC is settled through RBI using SGL fund. Remember it, SGL sovereign government bond. So friends, SGL, right, plus fund. So this is how GSEC is handled. This is called settlement risk. Corporate security, it is settled via CCIL, right? So this is settled by a CCIL, Clearing Corporation of India Limited, or other depository. If we talk about the forex, so time zone gap create a lag risk, right? And if we talk about PVP, that is payment versus payment via CLS, it reduce the foreign exchanges. So remember this technique: DVP deal, right? Not always feasible. GSEC done through SGL, corporate securities settled via CCIL, forex time zone gap causes settlement lag risk, and PVP via CLS. Right. If you look at the purpose of this exposure ceiling limit, right? What is the purpose of this limit? Let's look at it on the right side. So basically, the exposure limit are like your shield. They control credit risk and counterparty risk. Remember, we have just talked about credit risk. So they keep credit and counterparty risk in check. Also, they promote diversification, and they most importantly they prevent the concentration risk, because putting all your egg in one basket not smart in treasury. And the last we have is called the monitoring and review responsibility. Who monitor it? Just like we have seen, the stop limit is monitored by back office, but in the case of this exposure ceiling limit, it is monitored by setting limit is just step one. Enforcing them is the key. So this job lies with the back office and the mid office. And yes, there is a mandatory annual review to ensure everything stays in check and up to date. So exposure ceiling limit are not just policy; they are the backbone of treasury risk management. They help institution breathe easily while handling large volume with multiple players. Friend, if you are interested in such kind of content for each and every units of CAIIB, you can enroll in our crash course, which hardly costs rupees 650 for the entire 5 subjects. And in the crash course, we are covering only thing that matter. If you want to get more detail, feel free to WhatsApp me on this particular number. Right? Please save this number for any query related to the CAIIB. Now, friends, let's look over to the next slide we have. So friends, we are diving into one of the most misunderstood yet powerful tool in the bond analysis, that is called duration. Right. So duration simply tells us one thing: how sensitive is a bond to the interest rate change. That is what duration tells us. You see the definition here, right? So the definition is quite simple. It shows you the interest rate sensitivity, which means how sensitive our bond to the interest rate change. If you are in investment business, especially dealing with bond, you must know how even a small rate move can shake up your return. That is exactly what duration measures. But the question is, why duration? Because let me talk about why duration. I think here we are. Why duration? You can see why duration is necessary. Because duration gives us a weighted average life. It gives us a weighted average life of a bond cash flow. Right? It gives us a weighted average life of bond cash flow. Right? It helps calculate the present value of the future payment. Super useful when comparing bond or predicting impact of rate change. But if you talk about the limitation of YTM, that is called yield to maturity, a common mistake thinking that YTM is equal to risk. No, YTM does not capture bond maturity impact. Right? YTM is not as the risk. Duration matter. Right? So it does not capture. Let me show you. It does not capture maturity. Right? Coupon effect, or how sensitive the bond is to rate change. That is why duration, why YTM ignored the sensitivity. That is why duration is used here when it comes to risk analysis. YTM is not sufficient. Right? If you link it with the YTM, here you can see on the right side how duration is linked to the YTM. So duration and YTM goes hand in hand. To calculate duration, you need YTM, that is called yield to maturity. So YTM help discount each cash flow to get the bond present value. Yeah, right? Because YTM is the rate at which you do the discounting. But duration, it goes one step ahead by showing how much a bond price will change if interest rate change. Right? So this duration tells us, this duration shows us how much the bond price will change if the interest rate change. Right? So it goes one step ahead. And YTM is used for discounting purpose. This is the rate at which you discount the bond to get the present value of the bond. If we talk about the nature of the bond, so here you can see on the right hand side, let me show you. This is the nature of the bond. Right? If we talk about it, so basically different bond, different behavior. We have government bond, we have non-government bond, bill, debenture, right? So bond can be priced at par or discount or premium depending on the market yield. Now if we talk about the price yield relationship, here you can see at the bottom. So what is the price yield relationship? It is quite simple. When yield increase, price decrease. When yield decrease, price increase. So in this inverse relationship form the basis of most bond trading strategy, and duration help and quantify that effect. If you look at the market dynamic on the left side, what does it mean? So basically, real world impact bond price move with maturity, right? And also interest rate trend. Why? Because when rate is increasing, price is decreasing. When rate drop, price increase. So duration help you navigate this market wave confidently. And if you talk about the yield, here you can see the yield. So yield, what does it mean? So let me show you. So if we talk about the yield, so yield is the actual return you are getting. It's not just interest. It includes coupon, it includes price gain or loss, it includes maturity payout. It is also called IRR, internal rate of return. So yield shows your cash flow are really worth. So what we learned from the discussion is that duration is your financial compass in the bond world. It tells you where you stand, how far you can go, and what bumps you might hit along the way. So whether you are managing a portfolio, analyzing investment, always know your duration. That is the role of duration here. Right. Now friends, let's switch to the next topic that we have. The next topic is understanding modified duration and its application. Yes. So friends, if you have already got a grip on basic of duration, let's now step into more refined cousin, that is called modified duration. Think of like duration 2.0. More precise, more predictive, and incredibly useful for investor and risk manager alike. So modified duration is calculated as duration divided by 1 plus yield. Why is this useful? Because it tells us exactly how much a bond price will change for every 1% change in the interest rate. For every 1% change in the interest rate, how much the bond price will change. This is what is indicated by the duration. So suppose MD is equal to 5, right? So and yield rise by 1%. So what will happen? The bond price will fall by 1%, right? Very much clear. Now friends, if you look at the convexity adjustment, you can see here. So modified duration is first order derivative. It means that it shows the initial impact of rate change. Remember, this modified duration is called the first order derivative, right? Because it shows the initial impact of rate change. But for bigger non-linear move, we had a convexity adjustment, which we call second order effect, right? In simple term, duration is a speedometer, while convexity means steering adjustment on the curve, right? So modified duration, remember, it is the first order derivative, right? Now the second thing we have to study is the application. So let's say interest rate rise by just 5 basis points. So you can use modified duration to quickly estimate the bond price drop, because interest rates increase, bond price will drop. You know it very well. So using modified duration, you can know how much bond price will drop if interest rate rise by 5 bps, right? So no need for complex spreadsheet, but there is a limitation also. That it work accurately for a small change in the rate. Why? Because it assumes that yield curve is linear. Yes, this is the assumption that it makes, that yield curve is linear, which is rarely true in the real world. For bigger swing, you need convexity also, right? Convexity is also required. And if you look at the duration in finance, so this is where modified duration truly shines. It helps bank and financial institution manage the difference between assets and liability duration. You can see through this through this tool, modified duration, the institution, financial institution, can manage the asset duration and liability duration difference, right? It is a key metric in macro hedging, helping bank interest rate risk across the entire balance sheet. So modified duration gives you a sharper, a smarter way to measure the bond risk. It blends math and market sense into a tool that is both practical and powerful. So the next time someone say interest rates are changing, you will know exactly how much impact it is going to have.
Main concept is clear. It gives you the right, but not the obligation, right? It does not give you the obligation, right, to buy or sell an asset at a fixed price in the future. So you can see written, it is a right but not an obligation to buy or sell an asset at a fixed point in the future. There are two types of options are there. One is called call option, which means the right to buy, and other is called put option, the right to sell. And these rights apply to a future date. They both call option and put option apply to the future date, making option a powerful tool for both speculation. So whether you speculate or whether you hedge, for both of them, this option is a great tool. If you look at the types of option that we have, so let me show you the types of option. Just wait a minute. Yeah. So you can see the American option is there, and there is something called European option. You know about it? American or European option, let me tell you. So American option means it can be exercised anytime. American, A for America, A for any time. This way you can remember it. American option can be exercised anytime before expiry. Whereas European option, it can be exercised only on expiry date. It can be exercised only on expiry date. This thing you must note it down. And fun fact is that in India, mostly option follow the European style. Post 2008 crisis, American style option are banned in many market. There are some key terms which you need to remember. The first is called strike price. So here let me show you the detail regarding the strike price. So one thing is that this is a crash course. It provides you complete important information in just 20 to 30 minutes, so that your main focus should be on MCQs attempting. So what is a strike price? A strike price is the price at which the option holder can buy or sell, which means it is fixed by the holder. Holder fix it. And expiry date is the deadline to exercise the option. these two parameters are fixed by the holder at the time of purchase, that yes, I will exercise this particular option on this particular date. The price, and the price at which the option holder can buy or sell is called strike price, and expiry date is the deadline to exercise the option. And so European American option we have already told you. Now when there is something called moneyness is your option profitable? So whenever I say this moneyness, it basically means I am answering a question, that is option profitable? Is it really profitable? That is what I am answering. So moneyness tells you where the strike price stands compared to the market price. So see, I just told you regarding the strike price, regarding the market price. So where the strike price stood in comparison to the market price, that is what is told by moneyness. So there is something called ATM. ATM means at the money. So at the money means what? That strike and spot price both are equal, or forward price both are equal. Then there is something called ITM, which means in the money. So in the money, two things are there. Try to understand. If it is call option, then a strike will be less than the forward price, and if it is put option, then a strike will be greater than the forward price. And the last is called OTM, out of money. Then in this case, if it is call option, then a strike will be greater than forward, and put option, a strike will be less than the forward. I have told a trick to remember these things in our videos, right? Now if you look at the intrinsic value, in short it is noted by IV. In short, intrinsic value is noted by IV. So this is the real value of the option. Remember, intrinsic value is called the real value of the option, right? So what happened? Only ITM option have intrinsic value. Remember it, very important, that only ITM option have intrinsic value. For call option, intrinsic value, if you want to find, how to find the intrinsic value? You subtract a spot and a strike. And for put option, you subtract a strike minus a spot, right? So this is how you will find intrinsic value for call option and put option. And so this is only ITM has intrinsic, I told you right? While ATM and OTM, intrinsic value is 0. There is no intrinsic value for ATM and OTM. Understood? Right. So friends, one more thing is there, is called time value. After intrinsic value, something important is called time value. So it is the extra premium you pay for the time left until expiry. So one formula you must remember, that if you want to find the option price, so you add two things. First of all, you add the intrinsic value, and then you add the time value. And this time value is highest at the ATM, at the money, right? Time value decreases as expiry near, or when the option is deeply ITM and OTM. So let's summarize what we learned from this particular slide, is that options are more than just a bet. They are a calculated strategy. So once you understand the types, terms, valuation, you can unlock a world of smart financial decision. And that is all we have discussed just now. We have covered every possible aspect in just one single picture, and this will help you, really help you, right, at the time of examination or revision part. And that is the beauty of our crash course. It helps you revise the entire content in a super efficient way. In just 20 to 30 minutes, you can revise the entire chapter. Right now, friends, let's switch our attention to the world of stock option. So in the world of financial instrument, stock and index option are a powerful tool for both hedging as well as speculation. Let's explore the type and feature and make them so versatile. So first of all, what is stock option? Let me take you to the world of the stock option. See, a stock option gives you the right to buy or sell a company equity as a predefined strike price. Yes, there is a fixed strike price at which you can buy or sell a company equity. That is the stock option give you. For example, suppose you hold a put option of 1,000 share of Maruti, right, at 29,000, at rupees 9,000. So suppose you hold a put option on 1,000 share, right, of Maruti at 29,000, expiring on 30 June 2022. Right. So suppose the price fall below 9,000. So you exercise the option and sell at 9,000. And if your price is exceed 9,000, you simply sell in the open market. Right. No option exercise. Simple. It is quite simple. Because put means what? Selling. Just you have put option. That means it gives you the right to buy or sell a company equity. So in this case, you have put option. That means you can sell it at 9,000. Suppose the price is below 9,000, then you will exercise this particular option. And if the price is larger than 9,000, you will not exercise. You will simply sell in the market. So that is what stock option is all about. I told you about the stock option now. So it's a smart move to lock in profit or hedge against loss. Then the second part is called index option. What is the meaning of this index option? Let's see in this particular slide. Right, I told you now, every aspect will be made clear. From all the things have been taken from your Macmillan book. Index option means what? These are the options based on the market indices. And market indices like Sensex and Nifty, not individual stock. So a put option help you protect against market fall. In the case of index option, it help you protect. Put option help you protect from market fall, and call option protect against index rise. Call option protect against index rise. It is useful for a stock broker, a stock buyer, right? Those who need downside protection. Now, if we talk about the type of stock option, in the right side, I will tell you, right, the type of stock option that we have. So one thing that is called plain vanilla option. You know about this plain vanilla option? What is it? This plain vanilla option is a type of a stock option What it is all about, let me explain using an example. So basically, these are the simplest and cleanest type of option. There is no complex condition, no condition, right? It's perfect for him. And premium you have plain vanilla option, right? But comes with a trade-off. What is trade-off? The trade-off is that you have to sacrifice either upside or excess, right? So think of it like a standard coffee of the option world: simple, reliable, and effective. It is simple option, no condition. It's ideal for him, right? It is a combination of options, and premium is lower. That means you either sacrifice upside or accept some risk, right? So design as per holder risk appetite. And there's something called a zero cost option. You know about the zero cost option? Let me tell you. So you can see zero cost option. Plain vanilla option, just now I told you, zero cost option. This involves no upfront premium. No premium you have to pay, but have built market risk. In the case of premium, since you are exercising this option, you have to pay premium. But in zero cost option, zero cost is no premium to pay. That is why it's called zero cost. But it has some market risk there. Like suppose there is something called range forward. Range forward means what? You get better rate unless market crosses that level. And there is second is called bear, which means it becomes inactive if market moves in a certain direction. So it is ideal for those who want protection without paying premium. Suppose you want protection, you want insurance, but you don't want to pay premium. Then the zero cost option is the very ideal thing. But are okay with certain, yes, you are okay with certain condition, but you don't want to pay premium, right? It's okay for them. Like if range forward, high rate if market crosses such a very level, and value option, that is becoming invalid if market move in a certain direction. That there is condition involved here. Because not paying premium, they have to satisfy some condition. And the third option is called exotic option. You know what is exotic option? See, these are designer option related to the complex strategy. So they combine option and they combine derivative. The combo of option and derivative, right? And they create a custom financial product. There's something multi-market exposure. There is something multi-risk hedging. There is something called high risk. It's not there for basic hedging. So friends, it is used in structured product. It is used for structured product. They offer custom protection, not standard safety. That is called exotic option. So final thought is that stock index often come in mid flavor, from plain to exotic, from zero cost to tailor made. So whether you are managing risk or maximizing return, there is a strategy for every kind of investor that you have. So can you tell me what is the flavor of choice? I've given you 3 flavor: exotic, plain vanilla, and zero cost. And those are asked every year from these 3 types. You must know everything about it. Now friends, let's move to the world of interest rate swap. Ever heard of swapping interest rate without exchanging actual money? That is exactly what is interest rate swap. It is a smart way to manage borrowing cost. So first of all, look at the definition. Right on the left side, you will see the definition of interest rate swap. In short, we call it IRS. So IRS is the exchange of interest payment. Simply, it is exchange of interest payment on notional amount. Here you can see this. It is the exchange of interest payment on notional amount. Right? And notional principal is not exchange. It is just a reference. I told you that notional principal reference is not exchange. Rather, it is just reference. So the swap helps shift between fixed and floating interest rate and vice versa. So it is used for shifting either fixed floating to floating. Right? So that is what swap happens. Again, I'm telling you, principal is not exchange. It is just acting like reference. Swap help you shift between fixed and floating interest rate and vice versa. Now the question is, how does it work? Let's look at the next. So friends, each part act as if they borrowed the full amount. Each part act. So there are 2 parts. There are 2 parts. So each part act as if they are borrowed the full amount. But in reality, they only settle the net difference on the aggregate date. Think of it like splitting the bill. Only the difference is paid. That's it. Nothing else. But it looks like they borrowed the full amount. Let's understand it with an illustration. Make it more clear. So here I have provided illustration on the right side. You can see. Say a company. Suppose a company, right? It is with a demand at 7%, right? Which but want to benefit from a floating rate. So what they do? They tell us swap. Right? They agree to pay floating, which is still 2% rate. Right? In return, they pay 7% by bank. Right? Suppose bank pays 7% to the company. Suppose bank pays 7% to the company. So the company pays treasury bill plus 2% to the bank. Right? And suppose what happens? Company pays 6% and receives 7%. So the result is saving of 1%, isn't it? So basically, this is the advantage of having a swapping with the bank. It is smart, right? Now let's look at the benchmark rate. What is the benchmark rate used in the case of IRS? Every aspect has been taken care of in this particular slide. You did not remember anything. If you revise it twice, this will be more detailed. Right? Instead of learning from 10 different material, just revise one material 10 times. This is the secret to success in the CAIIB. And that is what we do in our crash course. And I provide pinpoint content. If you go through only that content 2 to 3 times, those theory and solve sufficient MCQs based on them, that is your pass to the CAIIB. Nothing can stop you from receiving good marks in the examination. So now friends, let's talk about benchmark rate. A floating rate is often linked to a benchmark like treasury bill, right? A risk-free rate. So the total floating rate can be into bill plus credit premium. Obviously, credit premium you have to pay some premium for exercising this interest rate swap. Now, if we talk about swap and condition, so see, there is something called swap buyer, they fixed, and there is something called swap seller. So who receive fixed, right? So company may pay fixed and receive floating, or vice versa, depending on their risk profile and their rate outlook. So what we just learned is that interest rate swap, it means only interest flow exchange. Principal is not exchange. It helps manage exposure to changing rate. It is great for cost saving and flexibility and financial engineering, right? Now friends, let's look at the financial benchmark and interest rate swap. Very, very important. In the world of finance, benchmark are the heartbeat of the interest rate swap. They help determine how much interest is paid or received and by whom. Let's break this down beautifully. So first of all, we have the INR benchmark. So these are commonly used interest rate reference in rupees swap. If we under rupees swap, the commonly used benchmark are the following. The first is overnight MIBOR. This is called overnight Mumbai Interbank Offered Rate, 90-day Treasury Bill, which is a short-term government security rate, CP rate index, which is commercial paper, IN, BMX, CMS, and MIFOR. So these are used for medium to long-term swap. So these benchmark guide the floating leg in an interest rate swap. If you look at the type of interest rate swap, already I told you there is something called plain vanilla swap. The most common things, fixed to floating, it is allowed in India. If you talk about the second type, it is called quanto swap. You know what is quanto swap? Quanto swap means payment in home currency but based on foreign interest rate. Payment is done in the home currency like INR, but it is based on the foreign currency rate. Coupon swap. Coupon swap means what? Interest fixed in one currency, floating in other. Great for international deal. So in one currency, interest is fixed, and in the other currency, it is floating. Interest rate is floating. Then it is good for international swap. And there's something called swaption. Swaption means what? You read it right. these are option built into swap contract. So see, it is combination of two things, option plus swap. Option built on swap contract. You can choose whether or not to enter into a swap later. If you look at the USD benchmark here, you can see USD benchmark. Friends, for global swap in the international market, swap often refers to ARR, alternate reference rate. Means it has replaced the LIBOR globally. Now earlier it was just LIBOR. Now it has been replaced by ARR. This is the USD benchmark. For global swap in the international market, swap often refers to ARR. And the second rate is called Fed rate, which means the key. And let me zoom a little bit so that it becomes very much clear to you. So what we learned from this discussion is that benchmark is the base for calculating floating interest rate. Swap can be domestic or swap can be cross currency. Each type of swap fit a specific business need or market condition, and regulatory body ensure that game is fair. Now friends, let's look at FRA. Have you ever worried about interest rate rising before your loan start? Tell me. Suppose you have taken a loan. Before a loan start, you are worried about interest rate rising. Have you ever done that? So forward rate agreement, are you sealed against this risk? Yes. So forward rate agreement or FRA, what it does, it let you fix an interest rate today, right? It let you fix interest rate today, right? You can think of this like IRS. It's just like an interest rate swap, right? But with a twist. What is the twist? The twist is that it is just one single payment, not a series, right? So if you are worried about interest rate will rise in the future, I have just taken a loan, then you can go into FRA, right? It's just like an IRS but for a single payment, right? Not a series. So it is mostly used to hedge interest rate on future deals, right? So if we talk about the key difference between FRA and IRS, it is quite simple, that IRS is an ongoing, IRS is an ongoing periodic interest flow, but the case of FRA, it is just one time interest payment in the future. It is simple, direct and to the point. Let me give you one example of this to understand. So suppose a company loan reset on 29th June. Suppose a company loan reset on 29th June, right? Now, basically they fear interest rate may rise by then. They fear that loan will reset on 29th June and then interest rate may rise by then. The solution is that they buy 6/12 FRA, right? So which means locking in today's rate for the 6-month period from 29th June to December, right? So what is the difference here? 6 months is the difference. So they have locked in today's rate. What is the today's rate? They have logged in the today's rate, right? Starting from 29 June to the December. So since now they have fixed rate, this is a kind of peace of mind, right? This is a kind of peace of mind. So they lock the today's rate starting from 29 June to still 6 months till December, right? So if we talk about the market conversion, see how it is done. So rate fixed in advance, it is based on end of the previous period, right? Rate is fixed in the advance and interest paid at the end of FRA period. Remember, whatever interest is payment is done, it is paid at the end of the FRA period, right? And but interestingly, payment is settled at the start of FRA period and discounted back to present. This is how the market convention works. Rate is already fixed in advance, right? And then interest paid at the end of FRA, interest payment will be done at the end of FRA, but payment is settled at the start of FRA period, right? Now, if we talk about the valuation, so FRA are typically valued using some risk-free yield. Their valuation is done through some risk-free yield curve, like government security in India, and if the market is liquid, then interpolated from market rate. Or trader may use the swap curve directly. So what we learned from this discussion regarding the FRA, that FRA is the interest rate insurance for future period. It is simple, one-time cash flow tool. It is used by smart corporate to protect budget from rate hike. Now let's end our discussion. So remember, FRA is the calm in the storm. It locks in certainty for what is coming next. Now friends, derivative might sound complex, but in India they have been crafted with clarity and control, right? Thanks to ISDA, right? So RBI guideline, keeping it clean and clear. Let's look at it. What does RBI guidelines shows? So basically in India only plain vanilla IRS are allowed. I told you earlier, right? So in India RBI allow only plain vanilla IRS. Here you can see, right? For hedging and speculation, no exotic, no complicated structure. Corporate can use IRS only for hedging, not speculation. Remember it. So RBI allow corporate to use IRS just for hedging, not speculation. Let me show you where it is written. Yes, here you can see. We can see it. Only plain vanilla IRS is allowed, no exotic structure. Corporate can use IRS only for hedging. Remember this key point. This will help you in the examination. And bank, PD, FI, mutual fund, right? They can use it for hedging, balance sheet, and market making. Yes, they are allowed to use this. RBI also ensured that they are capital norm for any derivative exposure. If you go through the ISDA master agreement, let me show you. In the right side, you can see ISDA master agreement. So basically, before entering into derivative, signing the ISDA agreement is mandatory. Why? Why signing an ISDA agreement is mandatory? Because it allows a uniform framework on jurisdiction, valuation, netting, and credit enhancement. So one agreement cover all kind of deals. No need for separate contract. Only confirmation and exchange. Single global agreement, no separate contract, only confirmation and exchange. It is backed by RBI, it is backed by FBIL, it is backed by FIMDA, right? So these provide global legal strength, right? If you look at the legal framework of it, just look at the legal framework of it on the right hand side. So friends, in the bottom you can see that RBI introduced a major boost. What RBI introduced? Dual jurisdiction under ISDA. RBI law, dual jurisdiction in ISDA. Right now, derivative can operate under both Indian law as well as a common law. That is what RBI has introduced, legal framework for enhancement. So this move empower global bank to
will help you cover the main aspect in just one single slide. So ever wondered how the RBI control the flow of money in our economy, or how money supply impact inflation and financial stability? In this slide, we are diving into the most powerful yet often misunderstood engine behind our economy, that is money supply and monetary policy. So at the heart of our money supply and monetary policy, there lies, as the heart of our monetary system, there lies something you call money supply and monetary policy. So first thing we have reserve money or base money. Here you can see reserve money, also called as base money. So is the foundation, you can call it, you can call it the foundation of it. So what it includes? It includes the RBI control mechanism like CRR, right? CRR, cash reserve ratio. It is a tool that help manage liquidity and keep inflation in check, right? It help in liquidity management and also keep inflation in check, right? By controlling how much bank can lend. So how much bank can lend, based on that CRR controls liquidity management. Now friends, from this base arise the broader concept of money supply. So this is called reserve money, this is called the base money, and from this base what originate? The broader concept of money supply originate divided into different layer. The most liquid form is called M1, right? So you can see this is the most liquid form. The most liquid form is called M1, right? And it includes currency with the public. See, what does M1 include? M1 include currency with public, currency with public, plus what it include? Plus cash, right? Currency with public. So M1 is the most liquid form. It includes currency with the public plus demand deposit. Here you can see now cash plus demand deposit, that is part of M1, right? And interestingly, it makes up about 25% of the M3, right? Which is the data of 2021. And the what is M3? M3 is called the broad money. You see, it is called the narrow money. M1 is called narrow money, and M0 is called the base money, and M3 is called the broad money, right? But where does all this money come from? That's take up to the source of money, source of M3. What is the source of M3? Primarily through credits, right? So let me take you the source of M3. You can see sources of M3 through credit availed, right, by the public and the government, right? And also plus net forex asset held by RBI and the bank. So these are the source of M3. Now a critical player here is the money multiplier. You know about this money multiplier? Very, very important. See, so money multiplier tells us how much money get created from 1 unit of reserve. So that is M3 upon M1, right? M3 upon M1 is called money multiplier. It tells us how much money gets created from a unit of reserve. And higher multiplier simply means that more lending. So higher multiplier means more lending. From 2020 to 2021, it ranged between 4.07 to 10.65. However, the RBI's role in currency circulation is more of a utility function. So let me tell you to this particular point, role of RBI in currency circulation. So if you talk about the role of RBI in currency circulation, it is more of a utility function, right? What it is? Utility function, right? Issuing notes, not directly controlling the money supply. Yes, note issuing is the role of the RBI. They are not directly controlling the money supply. A reduced multiplier here, it means less reliance on physical currency. If multiplier decreases, it means less reliance on physical currency. And M3, M3 is called the broad money. And what does M3 include? M3 includes currency plus demand and time deposit with the bank plus post office saving thing also included. But how does the RBI really control this system? So RBI has a smart system that is called CRR and SLR, and this is the RBI control over the money supply. You know about it? You can see the first point, that RBI control over the money supply is achieved through CRR and SLR. This is the tool that RBI use, right, to control the money supply. Again, I am telling you what are the name. The name are CRR and SLR, right? So as you can see, what is money multiplier, what is M1, what is M3, every aspect we have just covered now. This is very, very important thing right now we are discussing. So friends, these are very, very important part from where question are being asked repeatedly. Now let me take you through and finally, what is the ultimate goal of all this? So whatever we have done just now, money supply and monetary policy, what is the ultimate goal? So the ultimate goal, what is the objective? The ultimate goal is that to control inflation. You can see controlling inflation, and to ensure that financial stability. This is another goal, to ensure our financial stability and forex market stability, right? So that is the point. So the next time when you hear term like CRR, M3 or monetary policy or M1 or this term which I just told you, that money multiplier, so please you will know exactly what is going behind the scene. That is all we have discussed in this particular first slide. Now let's come to the second slide, and in this slide we are going to discuss CRR and SLR, structure and functioning in bank. Do you know what really happened behind the scene when RBI want to control inflation or pump money into the economy? The secret lie in two powerful tools. The first tool is called CRR and the second tool is called SLR. But what are they and how do they shape our banking system? Let's break it down. Welcome to the core of India's banking regulation, CRR and SLR, two foundation pillars that define bank liquidity, monetary policy, and the RBI control mechanism. Now let's begin with the regulatory framework. Here in the top left side you can see regulatory framework, right? So friends, you know the cash reserve ratio, or we call it CRR, right? So CRR is governed by section 42 subsection 1 of the RBI Act, right? And you know where bank must maintain a percentage of their NDTL, you know NDTL, net demand and time liability, with the RBI in cash. Yes, this has to be maintained in cash because the name itself is this cash reserve ratio. So you should remember the section name also, right? And this thing also. Friends, if you go through our entire crash course now, everything is presented in such kind of format where you can easily, this is called mind map, right? If you go through this particular PDF at least twice, everything will be it will be in mind, right? You will be able to recall it more frequently, and this is the most effective technique of learning. This is called mind map technique, right? You will be able to recall from, suppose question is asked in examination, you can easily recall. This is the beauty of our crash course. Now friends, if you come to the SLR, if you talk about the statutory liquidity ratio, it comes under section number 24 of the BR Act. Remember, CRR section 42, SLR section 24, right, of the BRA Act. And it required bank to hold a part of their NDTL in liquid asset. What are the liquid asset? Like cash, gold, government security. These are called liquid asset, right? But why do we need them? That is where the purpose comes in. Let's look at the purpose. On the right side you can see, because you know this CRR and SLR, they act like a liquidity cushion, where that means they support the RBI in times of crisis and reinforce its role as a lender of last resort. Yes, these are the lender of last resort, right? When no one is available to pay for bank, then RBI is there to pay for the bank. Now the question is, what about the bank liquidity? What about the bank liquidity? So friends, well, if there is too much liquidity in the system, it can lead to surplus fund and inflation risk. On the flip side, if the liquidity is low, it may lead to high interest rate and even rupee depreciation. You see, if high liquidity, it means surplus fund, inflation. If low liquidity, high interest rate and rupee depreciation, right? And you know, CRR and SLR help RBI to maintain the right balance, right? Now let's talk about the RBI policy role. Here you can see RBI policy role. You know, through CRR and SLR, RBI adjusts interest rate, manage exchange rate, ensure economic growth. So in the post-liberalization era, the RBI does not fix a strict target. Instead, it closely monitors market condition, especially forex volatility. Right? Remember, after liberalization, you know, that is 1991. That is called the post-liberalization. Right? What RBI do? RBI does not fix a strict target. Rather, it closely monitors market condition, especially forex volatility. And finally, we have the monetary tool function, right? So what happened in the monetary tool function, that you know, when SLR or CRR is increased, it is called tight monetary policy. So you must note it down that when SLR or CRR increase, it is called tight monetary policy, right? This absorbs liquidity. So whenever I say tight monetary policy, what it means, that it absorbs liquidity, it cool down inflation and slow the excessive growth. So remember, when CRR SLR increases, it is called tight policy. It absorbs liquidity, cool down inflation and slow the excessive growth. Now what happened when SLR and CRR are lower? So you know, when SLR or CRR is decreased, it is called loose policy. It is called loose policy, which inject liquidity to stimulate lending and you know, boost the economy. So you must know the impact of increasing and decreasing the CRR and SLR. So CRR SLR decreases, it means loose policy which inject liquidity to stimulate lending and boosting the economy. So the next time you hear about CRR or SLR change in the news, you will know exactly how it impacts inflation, how it impacts interest rate, and how it impacts even your loan EMI. Now friends, in this particular chart, I will tell you CRR applicability. This is a chart which I prepared and it will help you revise the entire content in just 4 to 5 minutes. Let's go through it. So friends, let's talk about this particular chart. So ever wondered how bank calculate the CRR? It is not just about the deposit you and I make. There is an entire structure that defines what is included and what is exempted. So while calculating CRR, there is an entire structure. Let's decode the blueprint of CRR liability. So to understand the CRR better, we need to look at the three main pillars. What are the three main pillars? The first pillar is the component of demand liability. right? This is the first pillar. The second pillar is is exemptions from CRR, and third pillar is component of time liability, right? Here you will see. So let's go through these three pillar: component of demand liability, components of time liability, and the exemptions or exclusion from CRR. So friends, let's begin with the demand liability. So these are the amount that bank must repay on demand anytime, right? As the name itself suggests, that this is the amount that bank must repay anytime as per the demand of the customer, right? So what it includes? It includes the current deposit. I think you know it. It includes the demand liability portion of the saving deposit. Yes, saving deposit also included. It includes the margin held against letter of credit. So you must remember what are the portion of the demand liability. So whatever margin which is held against letter of credit is a part of demand liability, right? Balance in the overdue fixed deposit account. This is a part of demand liability, right? Outstanding telegraphic transfer, demand liability. Unclaimed deposit, demand liability. Cash credit balance in cash credit account. See, credit balance, not cash credit balance, credit balance. So these are the demand liability. So question may be asked, which of the following is a kind of demand liability? You must know it. Now, this make up the core of day-to-day liquidity with the bank. Now, if we talk about the time liability, here you can see components of time liability. So these are the deposit that is repayable after a specific period. It includes FD. You can see fixed deposit is a kind of time liability. Cash certificate time. Then we have cumulative and recurring deposit. Time liability portion of the saving deposit. Staff security deposit is a kind of time liability. Then further we have gold deposit. Yes, gold deposit is also kind of time liability. Now let's look at the exemption from CRR. Yes, even credit balance in the overdue account fall under this category. Friend, what about the exemption from CRR? Some liability are excluded when calculating CRR. What are those liability? Remember, like here you can see liabilities. So liability is excluded from CRR. So paid up capital, right? Demand and time liability of the RRB. You know what RRB is, Rural Bank, right? So paid up capital. Then we have refinance from RBI, borrowing from RBI, net income tax provision, refinance from NABARD and SIDBI, and even claim from DICGC. DICGC, Deposit Insurance Credit Government Corporation. So it's the deposit insurance body. So these inclusion makes sure that reserve requirement does not put too much pressure on a specific or temporary fund. And furthermore, liability to IBU, Indian banking system, credit balance in ACU account, and demand and time liability of OBU. These are exemption from CRR. No CRR is taken from it. So remember, these are the liability excluded and these are the exemption from CRR. Paid up capital, refinance from RBI, net income tax provision, claim from DICGC, etc. Now, let's understand this as SLR and CRR. So the next time you hear RBI increasing CRR, you will know it is not just a flat rate apply on deposit, but a carefully calculated balance. Now friends, let's understand CRR and SLR. Right. First of all, let's talk about the CRR maintenance rule. Let me zoom a little bit so that picture will become very clear to you. And these are very, very important aspect. Let's understand. Banks are required to maintain CRR on fortnightly average basis. What? Question case study are asked. So on fortnight average basis, banks are required to maintain CRR with a minimum daily balance of 90%. Remember, minimum daily balance of 90% of CRR. What does it mean? That out of every 100 rupees you deposit, a portion must be kept with the RBI in the form of cash with no interest earned, just pure liquidity reserve. That is the point. So suppose you deposit 100 rupees, suppose you are a bank and you are depositing 100 rupees with the RBI, and you out of the every 100 rupees you deposit, a portion of this must be kept with the RBI in the form of cash. If you look at the CRR form, right, so there are two main ways to maintain CRR, right, and this is a very, very important thing. That that payment bank SFB, right, it is not for UCB, right. So for UCB, urban cooperative bank, this maintenance is not much required. This you should keep in your mind, right. And for bank SFB, it is mandatory. Now what are the CRR form? There are two forms. So form A and form B, right. What is form A? So this form A is maintained as a balance with RBI. And if we talk about the form B, it is about cash held by the bank in its own vault, right. So bank held cash in their own vault, right, but rarely used. So most of the time bank keeps CRR with RBI under form A. If you look at the interest on CRR balance, wondering what the bank earn on this reserve, well, no interest is paid on CRR balance. It is a pure liquidity tool, not a revenue generating asset. It ensured bank always have cash cushion just in the case. Now if you look at the SLR composition, that is called a statutory liquidity ratio. Here you can see all the important points regarding SLR. Let me zoom a little bit so that the picture become very clear to you. You know, all the things have been taken from the Macmillan book. This is the condensed form of Macmillan book. It helps you revise all the things very fastly, very efficiently, and you should focus 80% of your time on numerical solving and MCQs attempting. Now friends, if we talk about SLR, so this is also calculated on a fortnightly basis, but maintained in the form of liquid asset. Here you can see they are maintained in the form of liquid asset, right? I told you what are the liquid asset: cash, gold, approved government security. They are based on the NDTL, right? They are based on NDTL, net demand and time liability, and they are calculated as the average of, they are calculated as the average of second, third, fourth Friday of the preceding month. Remember, second, third and fourth Friday of the preceding month. They exclude the interbank liability. You can see excluded from SLR, interbank liability, right? So those things which are excluded from CRR are also excluded from SLR, right? So you can see SLR exemptions are given, like liability to the bank in India, ACU credit balance and OBU liability. They are exempted from SLR, right? But they are not been given a CRR exemption, right? So they are maintained in non-interest earning asset like gold and some security. If we talk about the SLR, so you remember these are the exemptions. Question may be asked that which kind of assets are exempted from SLR. So liability to the bank in India, ACU credit balance and OBU liability, right? Overseas banking unit. Now friends, if we look at the SLR maintenance, what does it mean? That SLR is maintained daily, unlike CRR fortnightly average. I told you now that CRR is maintained on the basis of fortnight, but no, SLR is maintained daily, right? So bank must ensure that their eligible asset match the SLR requirement each day. Think of it like daily health checkup for liquidity. If you look at the RBI discretion, right, so it may be cash, it may be gold, it may be approved security, right? So RBI can temporarily reduce both CRR and SLR requirement in the times of financial stress or to inject liquidity in the system. Obviously, if RBI want to inject liquidity in the system, what they will do? They will reduce this SLR and CRR, right? So this help control inflation. What are the penalties? Remember, well, if the bank failed to maintain CRR SLR, so some heavy penalties are there. As you can see, first day default, if it is first day default, penal interest rate at 3% above the bank rate. You can see first day shortfall 3% above the bank rate, and if subsequent day default happen, it is jumped to 5% from day number 2, right? Plus RBI may disallow further branch expansion, cancel license or take strict supervisory action, right? SLR default penal interest under section 24, right, under this section. Heavy penalty, reputation risk, strict compliance by the bank. So this is for CRR default. CRR default, remember, 1 day shortfall 3% per annum of the bank rate, continuous shortfall 5% per annum from day 2, and SLR default penalty interest rate is applied as per section 56 of the BR Act 1949. Remember, this penalty is super important, examination question asked. Now, one more thing I want to tell you, that at the core both CRR and SLR are the monetary policy instrument. You know it very well, that if you increase the CRR and SLR, what will happen? The liquidity will tighten up, right? And if you decrease CRR and SLR, what will happen? That you will inject the liquidity. So use smartly, they help tackle inflation, stabilize the rupee and maintain banking discipline. So the next time you hear RBI increasing CRR SLR, you will know it is not just a number game, it is a strategic move to balance the economy. Now friends, let's switch our focus to the most important aspect, that is modernizing payment and settlement system. So friends, Indian financial system has come a long way from paper check and long queue. Welcome to the age of high speed, secure and seamless digital transaction. So we decode the key player and the platform that is revolutionizing the payment and settlement system of country. You see, in your Macmillan book, you will get 3 through 4 pages, and just I have summarized all those content in just one slide, and this is a super efficient way to revise. If you want to be the part of this crash course, you can enroll in our crash course which I am offering at 35% discount. You can WhatsApp me on this particular number, or you can see the description section of this particular video. You will get the link to the crash course. There are individual subject wise crash course also available, and the combined crash course for entire CIB subjects, 5 subjects also available. Now friends, let's begin with the RTGS. RTGS is called backbone of our high value transaction. It was launched in 2004, right? RTGS allows real time and gross settlement of the payment. So what is the meaning of real time? Real time is transaction are processed as they happen. And what is the meaning of gross? Gross means no bunching or no batching. Each payment is settled individually, and it is used mainly for bank for large value transfer. And RTGS settle payment is central bank money, that is final and irrevocable, right? It is used for government security, It is used for forex settlement, interbank fund movement, and it is managed by Reserve Bank of India. Then we have second thing that is called Infinite and SFMS. What is Infinite? Let's talk about it. So that this is a super secure banking internet that is called Infinite, right? It is short for Indian Financial Network. The full form is Indian Financial Network, right? It is a closed network. Remember, it is a closed network which is developed by RBI for secure communication between member bank. Yes, so secure bank network. So if member bank want to communicate securely, they can use the help of Infinite, that is Indian Financial Network, right? And add to that SFMS. What is SFMS? That is a structured financial messaging system. You should know the full form. A structured financial messaging system, right? You can think of it like India's answer to SWIFT. You know what SWIFT, right? Society for Worldwide Interbank Financial Telecommunication. So India's answer to the SWIFT, enabling safe and standardized financial messages across the bank. So together, if you combine Infinite plus SFMS, right, this is the backbone of secure digital banking in India. Now let's switch our focus to the NDS. What is NDS? Negotiated dealing system. So this was launched in February 2002 and by RBI. This is the online platform for trading in government security and money market instrument. Yes, if you want to trade in government security and money market instrument, this is the online platform. Bank, primary dealers, mutual fund and other financial player, they use NDS, right? They use NDS. Why they use NDS? For issuance, right? For issuance they use, for reporting they use, and for settlement they also use. It is streamline government security trading and ensure transparency in the debt market. So that is called NDS. What is NDS? Negotiated dealing system order matching. It was upgraded in 2005. NDS was upgraded in 2005, right, with NDS OM, the order matching system. Unlike negotiated trade, this is an anonymous screen-based trading system. It is anonymous screen-based trading system. Think of it like a stock exchange for government security. You can think of it like a stock exchange for government security, right? So here order are matched automatically based on price, time, priority. So the keyword is called price or time priority. Based on this price or time priority, order are matched automatically, right? Fast, fair and transparent. It is used by bank, it is used by primary dealer, mutual fund, insurer and other market participant. If you go toward the CCIL, that is Clearing Corporation of India Limited. Remember that this is promoted by major bank, and CCIL enters and they clear government security, TREPS, tri-party repo, right? And the best part is that no need for physical check or confirmation message. Everything is electronic. Yeah, TREPS is called tri-party repo, right? Everything is electronic, secure and guaranteed. Then comes FX clear. FX clear is very important thing. Question are asked every year. Remember it. So FX for foreign exchange settlement, we have FX clear. It is for foreign exchange settlement, right? It is a platform developed by CCIL, and it facilitates STP. What is STP? Is straight through processing. Remember the full form. This is called straight through processing, right? It facilitates STP of forex trade. STP for forex trade is facilitated by FX clear, and this reduces the manual error, right? Manual error get reduced, improve speed and ensure that forex trading is settled with absolute certainty. Then comes the depository institutions. That how are these security held? So these security are held through depository institution like NSDL and CDSL. These are called depository institution, right? So they use DVP, that is called delivery versus payment system, to ensure that securities are transferred only when payment is received, right? They ensure that securities are transferred only when payment is received, and this applies to equity, bond and even government security. So there you have it, a robust, digital and highly secure ecosystem powering India payment from RTGS to NDS OM and from CCIL to depository. This is the invisible machinery that keep our economy moving, right? Friends, that is all you need to remember from this chapter number 22. We have covered every aspect from where questions are repeatedly asked, as you can see. So let's explore the powerhouse behind a bank finance engine, that is called integrated treasury. As you can see here, integrated treasury, right? Imagine it has the central nervous system that connect every financial artery from global market to your local branch. But how exactly do it operate? Let's break it down. First thing first is the risk management. We will talk about every aspect of it, and after going through this video, I request you to please solve quizzes which I have added in the today's course. Now first let's talk about the risk management. See, the treasury actively manages the market risk. So it actively manages the market risk management. How? Using some sophisticated tools like derivatives. Yes, it use some tools like derivative to hedge the market risk, to manage the market risk management, right? And so also it provide hedging against forex risks, forex rate and interest rate fluctuation, this derivative which acts like a tool. Now the question is, why does it matter? What is the significance? Because it not only protect the bank but also strengthen the domestic and the global linkage, right? So that is why this is very much significant. This derivative plays a super important role in hedging foreign risk as well as interest rate exposure, right? Now friends, let's look at the direct customer interface. On the right side you can see integrated treasury is not just about number, it is speak directly with the corporate client. It is speak directly with the corporate client. This is called one-to-one interaction. It helps tailor solution, build trust and bring financial strategies closer to the real business need. If you look at the RBI relaxation here, as you can see, the RBI plays a vital enabling role. It permits mechanism like FDI, foreign direct investment, ECB, external commercial borrowing, ODI, overseas direct investment. So these are some mechanism which are permitted by the RBI. And also we have resident forex operation, right? Plus it allow overseas exposure. RBI allow overseas exposure, but with a smart limit tied to a bank net worth. Yes. So obviously overseas exposure is allowed by it, but there is a limit which is tied to the bank net worth. If we look at the market arbitrage on the right side, as you can see, what about the market arbitrage? Let's discuss it. See that this is where a strategy meet opportunity. Yes, in market arbitrage what happen? Your strategy it meets your opportunity, right? So by analyzing market trend, right, bank can switch between rupee and forex. By analyzing the market trend, bank can switch between rupee and forex, right, or tap into global shift like rupee credit to US lending. It's a smart financial maneuvering at its best. That is called market arbitrage. What about the market integration? What about the market integration? As you can see on the right side, see, if we talk about the market integration, so with globalization and fast-paced technology, market are now more connected than ever. Treasury integrate money market, currency market, as well as long to short term funding and even security trading. This is very important thing. It integrate everything, global liquidity market, debt market, right? Also money market, currency exchange, long to short term funding and even security trading is integrated by the treasury. That is the point. Now friends, if you look at the integrated cash flow management, as you can see here, no more silos, no more isolation, right? Treasury ensure a unified approach to managing the cash flow. There is a unified approach which is maintained by treasury. So fund move smoothly across function. It's all about optimization and efficiency. If we talk about the access to the foreign currency, in the left side you can see access to the foreign currency through offshore operation, NRI deposit, EEFC and RFC account, ECB float fund treasury. What ECB do? ECB float fund treasury ensure a steady inflow of foreign currency, making global trade seamless. If you look at the financial reform, so friends, what is the financial reform all about? As you can see here, and there is something called rupee partial convertibility. Financial reform plays a supporting role here. With partial convertibility of the rupee and liberalized capital current account regulation, RBI has opened up treasury for a broader global playground. So remember, rupee is always partially convertible, and current account and capital account, right? Current account is freely convertible, capital account is relaxed, right? Largely RBI relaxed. So RBI has opened up the treasury for a broader global playground. And if you look at the difference between the merchant and trading business, so here you can see the difference between the merchant and the trading business. So the treasury strike a balance between handling customer transaction and managing the bank's own trading strategy. It serves as both service provider and the strategist, right? So customer transaction bank also have to handle, and bank owned business they have to handle. So there should be a proper balance between these two, and this is what is ensured by the treasury. So in nutshell, the integrated treasury is not just a department, it is dynamic, multi-dimensional engine driving modern banking. From managing risk to leveraging global market, it ensures that bank is not just surviving but thriving. You can see now different types of functions are it is performing. And on the top left side we have seen the risk management. We have seen the arbitrage opportunity also someone can take help of, right? We have seen access to foreign currency, some sources I have told you how, and also financial reform also, it is also playing a very important role. So that is all about the roles played by the treasury. Now friends, let's move to the next slide. When we think of a bank treasury, we often imagine a room full of complex financial instruments and high-stake decisions. But at its core, the treasury is built around three powerful pillars. What are the three powerful pillars of treasury? Let me show you. The first is called liquidity management, as you can see it here. The second is called proprietary trading, and third is called risk management. Let's decode these one by one. First of all, let's come to the liquidity management. See, the treasury ensured that bank always had the right amount of fund, that is called fund management, whether for short-term needs or long-term plan, right? So proper funds should be always be there, short-term need, medium-term need or long-term plan in single or multiple currency, right? That is called liquidity management. From managing cash flow to complying with the CRR SLR requirement. So you know, cash flow management is also there, and complying with CRR SLR requirement is also there, right? From managing cash flow to complying with the CRR SLR requirement, it keeps the financial engine running smoothly. It does this through what we call ALM book. Yes, remember, there is a book that we call ALM book, right? It is done through the ALM book, where internal risk and liquidity needs are monitored and balanced with precision, right? So as you can see, multi-currency compliance, then you know, it maintains reserves. So I told you now that two things, managing cash flow to complying with CRR SLR, that is a part of the liquidity management. Then we have second part, that is called the risk management. So after liquidity management, then comes risk management. You know what it means? See, risk never sleep, but the treasury is always a step ahead. By using tools like ALM support, you know, there is a tool that is used. ALM support is a tool. By using tools like ALM support, derivative is another tool. Right? And then we have client risk hedging tool. So by using this tool, it safeguard, that means you know, the treasury safeguard the bank finance. Yes, it safeguard the bank finance, right? This role also extend to the proprietary risk management. This particular role of risk management also extend to the proprietary risk management, where the bank protect its own position. And you know about merchant book? So basically this is part, I told you now, the liquidity management is a part of ALM book. Remember, this is very, very important. ALM book, liquidity management, right? And you know about this risk management. So here you can see this risk management is part of the merchant book. Merchant book plays its part. As you can see, merchant book, client forex, client means you know, foreign exchange client plus derivative, right? And it cover foreign exchange transaction and derivative exposure. And if you look at the proprietary trading, what is the meaning of proprietary trading? So beyond customer transaction, bank can trade for its own gain, right? Bank can trade for its own gain, that beyond the customer transaction, right? So treasury actively engage in trading currencies, trading you know, securities and derivative, currency, security, derivative, all these are actively traded by the treasury. The key objective of boosting profitability. This activity is tracked through the trading book. Remember, this activity, proprietary trading, is tracked to the trading book. So here you can see the ALM book is there for liquidity management. For risk management, you have the merchant book. For proprietary trading, you have the trading book, right? So trading book, what happens in the trading book? Where the bank take calculated position in the market, not for a client but for itself. So here you can see at the bottom, I have just summarized the fact that ALM book, it includes what? Internal risk plus liquidity management. It includes traditional liquidity function, ALM book, remember it. Then merchant book includes derivative and client foreign exchange risk. And if we talk about the trading book, it includes proprietary position. So remember, question is asked that liquidity management is taken care of in which kind of book. So you must remember ALM book. Proprietary trading is taken care of which kind of book. So you must know this is trading book. And what about risk management? This is the part of you know, merchant book. So this thing must be clear to you. Now friends, let's switch our focus to the next topic. That as you can see, just wait a minute, let me show you. So friends, now let's talk about the introduction and impact of the financial derivative in India. Every aspect have been declared, will be clear. Just go through this particular slide, right? That is our main motive, that we try to provide you every aspect in an easy to understand manner. Let's go through. So friends, financial derivative have transformed the Indian financial landscape. Once considered complex, today they are crucial tool for managing risk, enhancing liquidity and boosting the global connectivity. Let's break them down in their introduction and impact under the regulatory vision of RBI and SEBI. First of all, let's talk about the globalization impact. On the right top side, you can see the globalization impact. You know, as Indian bank and financial institution engage in more forex transaction, derivative help manage cross-border investment. Right, as bank and financial institution engage in forex transaction, derivative help them manage the cross-border investment. Right, both for the client as well as the on investment. In short, globalization is not just a trend; it's an operational shift, and derivative are the bridge. Right. So again, I am repeating that as Indian bank and financial institution engage in more forex transaction, derivative help manage cross-border investment. This is a very important thing. It helps them to manage the cross-border investment. right? Then we have then let's see the impact on bank treasury. What is the impact on bank treasury or derivative? See, bank treasury now have access to convertible fund. You know about this convertible fund? So bank treasury now have access to the convertible fund, which can be deployed across domestic or international market, as you can see. So this convertible fund can be deployed across domestic market also and international market also, though of course within the regulatory boundary. It's about smarter fund use driven by strategic derivative tool. This is the impact on the bank treasury. Third thing we have is currency future market. Currency future are traded into two major Indian exchange. What are they? So first of all, what are they? So remember, currency future are traded on two major exchanges, and what are their future? They offer high liquidity, right, and short-term flexibility, typically in 1 to 3 month contract, which is a go-to choice for corporate and investor managing the currency risk, right? So those who are managing the currency risk, they can go to this currency future market. This is a very good choice for them. Then we have something called CDS. What is CDS? Credit default swap. Basically, it was introduced to manage the credit risk in corporate bond. Remember why it was introduced? To manage the credit risk in the corporate bond, right? And CDS is a very powerful instrument. It acts both like a market maker as well as users. Bank act both like using CDS. Bank act both like market maker and users, right? So hedging through their banking or trading book. It's like insurance for your bond portfolio. So you can call this CDS as insurance. It's like insurance for your bond portfolio. Then we have cross currency future and option. So here you can see at the bottom we have something called cross currency future and on the option. So if you want to hedge a foreign forex exposure in yen while you deal in euro, suppose you want to hedge your forex exposure in yen and you deal in euro, right? So how can you do that? So cross currency future and option help with direct hedging and strategy execution. So here you can see direct hedging and strategic execution, right? No matter the currency pair, whatever the currency pair is, no matter, right? Here you can go about, if you want to hedge a forex exposure in yen while you deal in euro, so cross currency future and option help with the direct hedging and strategy execution. Then we have something called interest rate future, IRF. What is IRF? Do you know what is IRF? Let me show you. On the right hand side you can see interest rate future. See, since 2013, right, IRF are available on the stock exchange in India, right? RBI allotted. And what are their assets? So underlying asset include 91-day treasury bill, 2-year, 5-year, 10-year notional Government of India bond, or coupon bearing Government of India security, which is ideal for those looking to lock in or hedge interest rate movement, right? What about the RBI guideline? On 26 June 2019, RBI issued a comprehensive guideline covering both exchange traded fund and OTC, that is OTC derivative. You know about the difference? You should know the difference between exchange traded fund and OTC derivative. So these guidelines even cover ETP also, right? And replace earlier outdated direction, which was a much needed regulatory refresh. Now if you look at the overseas borrowing by the bank at the bottom, you can see, remember this is very important thing. Under this framework what happened, that a bank can borrow overseas via correspondent. Yes, bank can borrow overseas via correspondent, and there is a limit, there is a cap, either the higher of the 100% of the tier 1 or USD 10 million, whichever is higher, right? Ensuring stability even when enabling global expansion. So this limit you must keep in your mind, that for overseas borrowing there is a limit. Either suppose tier 1 is suppose 100 crore. What is 100% of tier 1? That is 100 crore. So either 100 crore or USD 10 million, whichever is higher, right? That is the limit that have been capped on the overseas borrowing by the bank, right? Remember this limit, super important from examination point of view. So everything we are discussing in this particular slide now, they have been appeared in the previous year examination. That is why it is here, right? And in the entire crash course, we ensure that I will provide you only those content which matter from examination point of view, nothing extra. So that your 80% time should be devoted to solving MCQs and case studies as well as quizzes. And if you want everything at one place, our crash course is a perfect solution for you, because in crash course we offer you on daily basis, we provide you with such kind of videos, we provide you quizzes based on them, we provide you MCQs based on them, so that you have fully fledged preparation. Now friends, let's shift our focus to the overview of the bank treasury activity. So welcome to the heart of the bank financial engine, the treasury. This is where the precision meets the opportunity. Let's decode the core activity that keep the treasury ticking. So let me zoom a little bit. First let's talk about the definition of the treasury. I hope it is now visible to you, right? So first of all, let's talk about the definition of treasury. Treasury is not gambling, it is a calculated as speculation, right? It is a kind of a calculated as speculation, right? Bank profit from price movement, whether it is buying low and selling high or taking a short position. But take a note, short selling in equity is not allowed by RBI. Remember, short selling in equity, this RBI does not allow, right? Then we have currency trading. See, at the center of the bank treasury like currency trading. At the center of the bank treasury, it's all about currency trading. Here bank take position in the global currency based on authorized limit, right, from the RBI. Yes, RBI set an authorized limit. Based on that authorized limit, bank take position in the global currency, whether it is long position or short position. It's all about smartly managing the foreign exchange gains, right? That is the currency trading. So it is kind of a speculation activity, just now I told you, right? Now friends, currency swap. So when timing is everything, in currency swap, bank buy and sell the same currency at different time, profiting from interest rate difference. That is called currency swap. So what the bank is doing, he is buying currency at one time and he is selling currency, bank is selling currency at a different time, right? And timing, since timing matter, so it is a powerful tool to manage the forward rate risk and balance exposure. Then we have open position concept. What is the meaning of open position? So open position means the unfinished trade, right? Open, why it is called open? Because it means the unfinished trade, right? So an open position means a trade that is not fully squared off. The value fluctuate with exchange rate movement. Remember, the value fluctuate with the exchange rate movement, and it is tracked carefully to manage exposure and to avoid the risk. That is the concept of open position. Means trade has not been fully squared off. Then if we talk about the trading in securities, here you can see trading in securities. What does it mean? When treasury trades security, it is often to profit from the yield chain, right? When treasury trade in security, it is often to profit from the yield chain. If yield fall, tell me what will happen. Suppose yield decrease, what will happen? Then government security rise in the value. Obviously price is inversely proportional to the yield. If the yield will decrease, government security value will increase, and that is how bank make gain. This is how bank make gain, especially in the NSE wholesale debt market. That is called trading in security, right? So whenever treasury trades security, it is often to profit from the yield chain. When yield decreases, government security price increases, and this is how the bank gains, right? Now we have SLR and excess holding. Bank maintain SLR, that is called a statutory liquidity ratio, right, and hold excess government security. Both has regulatory requirement as well as liquidity management tools. If we talk about the corporate bond and equity, treasury also invest in corporate bond and non-SLR equity, as you can see it here. Corporate bond plus non-SLR equity, right? So these are just diversification. They are often significant profit contributor. Then equity market activity. So basically strategic yet restrained. Though treasury do participate in equity market, it is done cautiously. There is a focus on profitability, but exposure is limited due to the market cap, which is set by the RBI. RBI regulation put a market cap on the equity market activity. Then we have something called trading in credit instrument. What is the meaning of trading in credit instrument? See, basically it means spreading the net wider. This includes trading in CDs, right? CD, certificate of deposit, commercial paper, NCDs, non-convertible debenture, right, and ABS, right? So here there are some name of some instrument, as you can see here written here, right? So it is a part of the broader credit market, especially in non-trade and banking sector. Then we have securitization market. What it means? See, securitization, though tightly regulated, it opens the doors. So bank trade in securitized asset, including CDs on corporate bond, right? This help reshape risk and reward dynamic, especially in complex portfolio. So treasury is not just a department, it's a financial strategy hub, right? From forex deal to security, every transaction is a move in a well-played chess game, right? And understanding this gives us a powerful insight into how banks truly operate behind the scene. Now let's look at the comprehensive overview of the treasury function. Friends, let's lift the curtain on the real engine room of the bank, the treasury department. It's not just about managing money, it's about strategic control, pricing, risk management. So here is a complete overview of its multifaceted function. First of all, it's the product offering. Let me zoom a little bit. I hope it is clearly visible to you. First of all, the thing is product offering. What does it mean? You can see whenever I say product offering, it means that treasury act like a product house, right? It act like a product house. So what is the meaning of product house? That they sell forex service, right? They sell forex service, and they sell derivatives, they sell a structured product, right? Especially designed to meet the need of corporate client. So they sell all these to meet the need of the corporate client, right? That is called product offering. Then with this, it is where customization with financial expertise, product offering. Then we have corporate hedging need. What it means? Treasury provide hedging solution that protect corporate from market volatility. Yes, this hedging solution is provided by the treasury that protect corporate. It protect corporate from market volatility. right? If you need to lock in interest rate, then use FRA. FRA, you know, forward rate agreement. We have already talked about it. If you want to lock the interest rate, use FRA. If you want to manage currency exposure, go for swap or go for options. It's all about converting uncertainty into clarity, right? That is called corporate hedging needs. You know, Treasury provide hedging solution that protect corporate from market volatility. Two tools I told you: forward rate agreement and swap, and you know, options. Then we have profit central rule. What is the meaning of profit central rule? As you can see that, don't forget, Treasury is also a profit center. Through transfer pricing, it assigns cost to the business unit based on factor like interest rate risk, maturity, and hedging cost. So you know, through transfer pricing it does so. Through transfer pricing it assigns cost to, you know, factors like, you know, interest rate risk, right, maturity mismatch, and hedging cost. This ensures accurate internal cost allocation and profitability. If you look at the transfer pricing rule, remember, think of it like, you know, bank internal rent system. Treasury charges margin for being the bank funding arm. Yes, Treasury charges what? Margin, right? And you know, compensating itself for acting like a financial backbone. This adds discipline and clarity to the interdepartmental finance. And then we have advanced pricing model. See, behind every decision lie a model. So any decision that the bank take, you know, there is a model that is lying. And you know, Treasury used advanced pricing technique, right? Often based on RAROC. You know what RAROC? Risk adjusted return on capital, right? Ensuring alignment with the Basel III capital norm. In simple term, they are managing risk and reward the smart way. So friends, from crafting product to pricing the risk, from serving corporate to the driving internal efficiency, the Treasury function is far more than just a support role. It's strategic powerhouse that hold the bank financial structure together. So you can see understand how much important is the Treasury. Now friends, the last slide we have, this is super important slide where we are looking at front office, mid office, and back office. Very, very important from examination point of view. So friends, behind the scene of every successful bank Treasury lie a well-organized machine divided into three core zones. There are three zones: front office, back office, and mid office. So let's decode the role and responsibility of each. First, let's talk about the front office. As you can see it here. So you know, this is the face of the Treasury operation. This is, you know, face of the Treasury operation, right? Where the market action truly happen. It is led by the chief dealer, right? And you know, this team is in charge of all the market facing activity. All the market facing activities lead by the chief dealer. And you know, dealers are the only ones executing the trade in Forex, money, or securities market. They cater to both corporate client and handle the ALM, right? So they cater to corporate client also, and they handle the ALM also, and they also manage the secondary market, right? They also manage the secondary market for securities like government security and treasury bill, right, and equities effective. So again, I'm repeating, chief dealer, right? So chief dealer, they leads the goal. This team in charge of the chief dealer, and you know, they cater to both corporate client and handle ALM. Yes, corporate client and ALM both are handled, and they also manage the secondary market like, you know, government security, treasury bill. On the corporate side, if you talk about the corporate side, they also handle, you know, investment proposals backed by thorough research. Chief dealer, right, Forex, money, security, this thing you must remember. Security market, basically they handle they caters. They are dealers are, you know, executing trades in Forex market, derivatives, and securities, and they also manage the secondary market for securities like government security and treasury bill. If you look at the mid office, so you know, the brain that monitor risk and compliance, right? So basically this is the watchtower. You can call them the watchtower, right, of the treasury, tracking risk, performance, and compliance. So it manages MIS, management information system, and risk system, ensuring KPI monitoring, right? KPI monitoring, key performance indicator monitoring, and set the trading limit. You can see they set the trading limit, and they also monitor the KPI, key performance indicator, right? It even handle the transfer pricing, and you know, and offer ALM support. Remember, questions are asked based on this. They offer ALM support also, right? It works closely with the risk head and maintain independence under ALCO to comply with the RBI norms. And finally, let's look at the back office function on the right hand side. You can see, so basically, you know, back office, the gatekeeper of the accuracy and settlement. They are the gatekeeper of the accuracy and settlement. You know, this is the backbone. This is the back office. You can think of backbone of the security operation. This is where everything get verified, settled, and recorded. So it handle the trade verification, it handle the trade settlement, right, and account reconciliation, right, and you know, it manage the bookkeeping, RBI return, as well as, you know, ensure the timely payment. And most importantly, it help mitigate the legal and reputational risk. It avoid legal and reputational risk. So basically, it also ensured that front and back office role remained segregated, avoiding conflict. And let's simplify a crucial concept in banking, that is called asset liability management and liquidity risk. Why does it matter? Well, for banks, balancing their asset and liability is like walking a tight rope. A wrong step can lead to liquidity crisis, but don't worry, I will break it down for you in the easiest way possible. First thing we have, is called the nature of assets and liability. You can see on the left hand side, the natures of assets and liability. So what does it mean? Let's see. First thing is that you can think of asset like cash inflow. You can think of them like cash inflow. That means incoming cash, right? So incoming cash is asset. I told you earlier also. That means when loans are repaid, whenever loans are repaid, money comes into the bank. That is why loan is a kind of asset to the bank. And if we talk about the liability, right? If we talk about the liability, you can think of the liabilities as obligation, right? Obligation. You can think of them kind of obligation, right? Liability, you can think of the kind of obligation that suppose when the deposit mature, right? Any kind of deposit, suppose when mature, right? So deposit maturing, money will flow out. So that is called liability. And this ALM ensure that a bank never run out of cash due to mismatch between these inflow and outflow. So we can see from asset cash is inflowing, from liability cash is outgoing. ALM ensure that there is no mismatch. Bank never run out of cash because of the inflow, because of mismatch between inflow and outflow. So that explains this nature of the assets and liability. Second thing we have is the measuring liquidity. How do we measure the liquidity? Let's see. The key question, does the bank have always enough cash to cover its immediate liability? Does the bank always have enough cash to cover its immediate liability? The answer is the net liquidity. Net liquidity decide that. Means the cash resource versus short term obligation. See, whenever I say net liquidity, on one side we have cash resource, right? And versus what? Versus short term obligation, right? So if liability exceed the cash source, if short term obligation exceed the cash source, the bank could face a liquidity crunch. A short term obligation, or we call it liability, if it exceed the cash resources, the bank could face a liquidity crunch. That is how we measure the liquidity. Now we have something called liquidity gap analysis. As you can see on the left side, this is called liquidity gap analysis. Friends, bank categorize their cash flow into time bands. So here comes the concept of time bands. What the bank do? Bank categorize their liquidity. In the liquidity gap analysis, the bank categorize their cash flow into time bands. As you can see next, so this is as per the RBI guideline, right? This is as per the RBI guideline that in the next day, or 2 to 7 days, or 8 to 14 days, or 15 to 30 days, right? And one thing is very, very important, that the meaning of positive gap and the negative gap. See, what is the meaning of positive gap? Positive gap means what? More cash coming in. It means advance is greater than deposit. And what is the meaning of negative gap? Negative gap means that more cash going out than coming in. This means deposit is greater than advance, right? So deposit is greater than advance, this means negative gap, right? So now friends, I think we have already discussed the source of fund, like loan repayment. Loan repayment is a kind of source of fund, and we have already covered the usage of fund. So what is the usage of fund? Like deposits, obligations, right? So these are called usage of funds. Now the source of fund and uses of fund, you find the difference between them. Source minus uses will give you the liquidity gap, and gap can either be positive or gap can either be negative, right? If gap is positive, it means advance is greater than deposit. Gap is negative, it means what? Deposit is greater than advance. So how do you find the gap? You subtract the source of gap from, and you subtract the uses of the gap. You subtract both of them and you will get the liquidity gap. This is how we calculate the liquidity gap. Now the question is how to manage the liquidity risk, right? So let's see, at the top you will see the managing the liquidity risk. So RBI plays a key role here, right? Insofar as managing liquidity risk is concerned, RBI plays a key role here, because RBI set threshold, liquidity threshold is set by RBI. You can see, right? So marketability is the key for liquid asset, right? So liquid assets should be marketable, and RBI is focused on short term liquidity. RBI is always focused on short term liquidity, right? And RBI has kept some threshold on maximum negative mismatch. Like you can see, in next day maximum negative mismatch can be 5%. In 2 to 7 day maximum negative mismatch can be 10%. In 8 to 14 day maximum negative mismatch can be 15%. 15 to 28 day maximum can be 20%, and so on. So the focus is on short term liquidity, so that bank never run out of the cash unexpectedly,
right? So this is how the RBI prescribe to manage the liquidity risk. So they put a threshold limit on the maximum negative mismatch, that for the next day maximum negative mismatch should not exceed 5%. That is the point, right? And based on these numericals are also asked, which I have added in today's quizzes. If you solve the today's quiz, which I have added in the crash course folder, you will get to know how to solve question based on them. But for the time being, you remember these limits: next day 5%, 2 to 7 day 10%, 8 to 14 day 15%, and 15 to 28 day 20%. Now friends, let's look at the liquidity and the cash flow. Here you can see. Let's talk about this liquidity and the cash flow. Basically, a bank with a positive cash flow is in a strong position. Obviously, if it is a positive cash flow, it means a strong position. And what are the key sources of liquidity? Some of the key sources of liquidity are, cash reserve, credit line, liquefiable security, and the nostro balance. Now, what about the contingency measures? What about the contingency measures? Here you can see. Let me show you. So in the top right side, you will see contingency measures. Basically, what if a bank suddenly need more cash? No worry, they have option. Like now, a standby credit. Yes, a standby credit option is available for them, right? They can take a standby credit from other banks, or they can take liquid investment. They can take help of liquid investment that can be quickly converted into cash, or they can borrow from via RBI by the means of LAF, liquidity adjustment facility, or TREPS, right? Repo, TREPS. Now friends, let's talk about the currency mismatch risk. What is the meaning of it? See, bank deal in multiple currency, and fluctuation can cause the currency mismatch. Obviously, suppose two currencies are there, USD and INR, and suppose both are fluctuating. So this fluctuation will obviously cause, currency mismatch. Who manages it? So it is managed by, the Treasury Department. The Treasury Department manages the currency mismatch. So inflow and outflow of different currencies is managed by the Treasury Department. And what is the RBI guideline? RBI ensure that bank follow a strict liquidity management rule, right? Bank must organize their assets and liability into time buckets. I told you early that yes, bank have to organize the assets and liability in the terms of time bucket, right? And monitor maturity mismatch more closely. Why? To prevent market liquidity dry up and for illiquid security issue. So final takeaway from this entire discussion is that, ALM and liquidity risk management is like a financial balancing act, ensuring that bank always have enough cash to meet obligation while also making profit, right? So we have seen what are the limits placed by RBI in the managing liquidity risk. We have seen the nature of assets and liability, right? We have seen how to measure the risk. We have seen liquidity gap analysis, RBI guideline, right? Time band and maturity. We have seen how bank deals with the contingency measures, currency mismatch. What is the role of currency mismatch here, and how liquidity and cash flow are related, right? So this is the first slide. Now let's look at the second slide. Let's look at the interest rate risk in ALM. So friends, let's talk about it. Ever wondered how bank deal with the interest rate fluctuation? One wrong move and their profit could vanish. That is why they use ALM, asset liability management, right, to tackle the interest rate risk. Yes, ALM is used to tackle the interest rate risk. But what exactly is it? Let's break it down using this flow chart. In this diagram, everything will be clear. First of all, you have to identify the mismatch. On the top right section, you will see identifying the mismatch. The biggest challenge is the repricing mismatch. This is one of the biggest challenge, so-called repricing mismatch. So what bank do? Bank categorize assets and liability into time buckets. I told you early that bank categorize assets and liability in terms of time bucket, right? To track when they reprice. So basically, what bank want to track? Bank want to track when they will reprice. And for that, what they do? They categorize assets and liability into the time bucket. And what are the time bucket? We have already covered in the previous lecture. I think there are 10 time buckets which is prescribed by RBI. So for example, let me give you one example. A 7-year fixed rate loan at 7% versus a 6 month to 1 year loan. Right, again I'm repeating, 7-year fixed loan at 7% versus 6 month to 1 year loan create a mismatch. Obviously this will create a mismatch because this is a 7-year fixed percent a deposit, or you can say it, right? You can say it deposit. And versus on the other hand, what we have? On the other hand, we have, you can see versus loan. Suppose this 7-year fixed 7% deposit, and on the other hand we have loan, you can see 6 months to 1 year. This will create a mismatch. Suppose interest rate rise, what will happen? One side earn less while other cost more. That is the point. I hope that makes sense to you. You have to identify the mismatch. Now let's look at the definition part. You can see the definition and impact. So interest rate risk is simply means that your earning is less than your payment,
whenever your earning is less than your payment, or we can say your expense, right? Or better word to use, your expense. Whenever your earning is less than expense, right, this will create interest rate risk. And when market rate change, bank may pay higher interest on deposit but on lower interest on loan, right? That will what we call NII. You know what NII, net interest income, which is interest earning minus interest expense. Suppose interest earning is less than interest expense, then what will happen? Obviously bank is exposed to the interest rate risk. So this mismatch leads to NII erosion of NII, affecting the bank profitability. Now one more thing is very very important here, that is called repricing risk. You know about it. Basically when assets and liability reprice at different times, it causes earning instability, right? Assets and liability are being repriced at different timing. For example, suppose there is a floating deposit of 6 months versus fixed loan of 5 years, right? This is a kind of repricing. So if deposit rate increase but loan rate remain fixed, the bank profit take a hit, right? Again I am repeating, suppose floating deposit 6 months, fixed loan 5 years, right? So in this case, suppose if deposit rate increase but loan rate remain fixed, the bank profit take a hit, right? Now the question is how to measure this mismatch. So repricing risk, I hope it is clear, because the timing of the assets and liability maturity is varying, right? That is called this repricing risk. Now how to measure this mismatch? One thing is quite clear, that mismatch is always there, right, between our deposits and our loan, right, between our assets and between our liability. How to measure them? So bank track the mismatch using absolute mismatch, right? What is the meaning of absolute mismatch? Which means difference between RSA and RSL. RSA means rate sensitive asset and rate sensitive liability. The first technique. Second technique they have is the sensitivity ratio, which is the impact of rate change. And the third technique is RSA percent versus RSL percent, right? So there are 3 ways to measure this mismatch. I hope you are familiar with this term, net interest income, right? It is nothing but interest earning minus interest payment. Higher interest rate risk can destabilize NII, right? Bank aim to keep this NII stable, right, to ensure financial health. Example I am giving you to make this concept more clear. So suppose scenario number 1, we have a fixed loan versus floating deposit. Fixed loan versus floating deposit, right? Deposit for 6 months at the rate 5%, loan at 5 year at the rate 7%. So what is initial NII? Initial NII you can see is nothing but 5%, 7% minus 5%, which is equal to 2%. Okay. Now if suppose deposit renew at the rate 6%, so instead of 5% it becomes 6%, then NII will become 1%, right? And suppose deposit renewed at the 8%, then NII become minus 1%. So you can see deposit rate is so you can see that deposit rate is increasing, so NII is decreasing. But suppose instead of that deposit rate fall, then NII will rise. That is the scenario number 1. Let's look at scenario number 2. We have fixed deposit versus floating loan. In the case loan was fixed, but now suppose deposit is fixed. Suppose in this case deposit is for 5 years, which is fixed, and 3 month and it is funded by 3 month Hujan's bill discounting. Now in this case suppose rate is falling, right? What will happen? So low discounting yield and fixed deposit cost, and NII will decline. So we have seen both the scenario, right? In first scenario our loan was at fixed rate, in the second scenario our deposit is at fixed rate. You can see in both the cases, if interest rate is changing, consequently it has an impact on NII, right? So you have to decide. You can't say that we can one case we can ignore the impact of NII. No, in both the case our assets and liability are exposed to this net interest rate erosion. Sometimes it is erosion, sometimes it is expansion also. Now friends, how to manage the interest rate risk? So bank takes some proactive step to minimize the risk. So what they do, they monitor the preset limit, right? They use something called derivative, and they use swap floating, right? Fixed or floating. That swapping is a method, right? So friends, interest rate risk is a game changer in banking. If not managed well, it can shrink profit and cause financial instability. But with proper ALM strategy, bank ensure they stay profitable no matter how interest rate might move. So friends, I hope this particular table help you understand each and every aspect. First of all, we understand what is mismatch. How do we identify the mismatch? How do we measure the mismatch? What is repricing risk? What is the impact of repricing risk? We have taken one example. What is NII? We have taken one example to understand that yes, either we have the case of fixed deposit, or we have the case of fixed loan. Both cases are exposed to the net interest income risk. And finally, we deal with how to manage the risk. That's it, right? I hope that makes sense to you. Now friends, let's look at the use of derivative in asset liability management. Very very important. Ever wondered how bank handle risk when interest rate fluctuate or currency value change? Right. So the answer lies in the derivative. Derivative are like financial tool which help bank hedge risk, manage liquidity, stabilize earning. Friends, if you are looking for such kind of videos which clear your concept in hardly 30 minutes, right, you don't have to go through the lengthy videos which take 5 to 6 hours to clear a concept. Yes, we have also that, but at this time what is required, to put more time to practice, right? It's not that time that you put more time to theory reading. So what is our main motive through the cash course is that you devote at least 80% to 70% of your time to practice through MCQ solving, and just 20 to 30% to the theory reading through videos or through PDF. This PDF will help you revise the concept quickly, fastly at the last time. As you can see, they are the short and crisp note possible. You can take help of our crash course. For more detail, feel free to WhatsApp me through this particular number. Right, please note down the number 8292857381 for any detail related to the crash course or any study material related to CAIIB. Friends, let's continue our discussion. So friends, let's talk about first of all currency mismatch. Right, I think we are familiar with it. Foreign currency loan receivable faces risk due to exchange rate fluctuation. What is the solution? The solution is that bank use call and put option here. Right, so they buy call. So by buying the call, what they do, they hedge foreign currency loan repayment. Right, if suppose currency appreciate, no extra cost, and if they buy put, then they protect foreign currency receivable value. Right, so this is, you can see, currency mismatch can be taken care of by using this call and put option. Now the question is managing the risk. You see, bank use derivative to control liquidity and interest rate risk. For both of them, either liquidity risk or interest rate risk, bank can use derivative. A structured risk, you can see, a structured risk mitigating product replicate market movement for better risk control. Right, now there is something called treasury arbitrage. Do you know about this treasury arbitrage? You see here, treasury arbitrage, what it is. See, bank borrow in one currency and lend in another to earn profit. So they borrow in one currency and lend in another to earn profit. As you can see, they borrow dollar for 6 months at the rate 3%, right, and they lend that money in Indian rupees for 6 months at the rate 6.5%. So what is the gross spread here? If you see 6.5 minus 3, which is equal to 3.5%. So this is the gross spread for the bank, isn't it? So after hedging foreign exchange risk, which is the premium, which is 1.5%, the net profit is just 2%, because this is the spread, this is the ultimate profit. But there are some premium they have to pay, and what premium they have to pay? Premium almost amount to 1.5%. So we have to deduct this premium from the spread, and finally the net profit is just 2%. So you should know how to calculate the arbitrage, how to calculate the spread, how to calculate the net profit, because some numerical based question may be asked. Now friends, let's look at how do we structure the banking products. Right, how do we structure the banking product? So let's see here, let's see the top right corner. Right, basically there is something called floating deposit or floating loan. If product is like floating deposit or floating loan, then it is linked to the benchmark for better control. Better is to link to the benchmark. This is how you control them. And suppose your product is government security. If it is government security, then inflation linked for stability, then it should be linked to the inflation. Or if it is a corporate debt, suppose it is corporate debt, like suppose it is a call put, so call put option, so then in that case call and put option will boost liquidity. So remember, depending on the types of product, you can use different technique, right, to hedge this asset level or interest rate risk and liquidity risk. Again I am repeating, if it is floating deposit or floating loan, you link it to benchmark link. If it is government security, it should be inflation linked. If it is corporate debt, it should be call and put option linked. For example, you can see here a 7-year bond with put option at the rate 3 year is equal to 3-year investment. It acts like a 3-year investment, right? So this is how you should structure banking product. Like we already know that whenever you take any kind of loan, it is always linked to the benchmark link, obviously. Now friends, if we talk about the hedging strategy, suppose bank hedge market risk using derivative like index future. Yes, so sensitive stock, market risk, obviously. And how do they use? So they sell index future to hedge such kind of market risk. If they sell index future, it protects a stock price from falling. And low capital requirement, making derivative an efficient hedge. Right, now friends, if you look at the IRS, you know what IRS? That is called interest rate swap. You see the case of IRS here. See, the problem is that basically this IRS or interest rate swap, it protect you from maturity mismatch. It protect the product from maturity mismatch. How? Let's see. Friends, suppose loan tenure is 3 years,
right? And deposit tenure is just 3 months. This is the problem. The problem is that loan tenure is 3 years, but deposit tenure is just 3 months. This is the main problem. So we have a short term deposit, as you can see, just for 3 months. So it is a cheaper but risky, right? So liquidity is always there, right? And interest rate risk is also there, because it has to be repriced 12 times. Now you can see 3 year means how many? 3 year means 36 months, and just your deposit is 3 months, so it has to be repriced 12 times. The deposit has to be repriced 12 times. So obviously it is exposed to the interest rate risk, and obviously liquidity is always there, right? So what is the solution? The solution is that you use interest rate swap. This is the solution. So I have told you the problem. I have just shown you the problem, that yes, we have to reprice the deposit 12 times, and obviously it is exposed to the interest rate risk. What is the solution? You use interest rate swap. What you do, you convert this the floating rate 3 month to fixed rate 3 year. This is how you should use swap. What you did, you convert the 3 month deposit which is floating to 3 year fixed, right? So what is the effect? What is the effect? The effect is that you receive your loan spread remain stable. First effect. Second thing is that you receive floating bill, floating treasury bill, and you pay fixed, and you lock the deposit cost, right? So 3 month deposit effectively become a 3 year deposit. So this is the advantage of using the interest rate swap. Now obviously we have just seen the advantages of these kind of techniques, like call and put option, like the interest rate swap, right? But there are some limitations also. Effective ALM require rational pricing. Yes, this is very important thing. Rational pricing is required, right? But swap fall if rate are not benchmark linked. Remember it, swap will fall if your rate is not benchmark linked, then swap will fall, right? So, and there are some embedded option. What is the meaning of embedded option? So embedded option like prepayment. Suppose I took the loan and I prepay the amount. Suppose I have a deposit and I ask the immediate withdrawal. Premature withdrawal. These are called embedded option. This embedded option can bypass ALM and hedge limit, right? So what is the solution? The solution is that a strong derivative market, skilled dealers, and efficient risk management. This is the solution. So first limitation of derivative is that it requires rational pricing, and the swap fail if rate is not linked to your benchmark, then swap will fail. Yes, interest rate swap will not happen, will not benefit you, right? So the solution I have told you. So derivative are a powerful tool for bank to hedge risk, to manage liquidity, and to ensure stability. But without proper ALM strategy, they can backfire. That is why bank carefully a structured product. I told you now, a structuring product is very much required. I told you at the top. You see why we structure banking product. We link this floating deposit and loan to the benchmark. This is very important, because derivative will work only when this is linked to the benchmark link. This is very important. Government security should be inflation linked. Corporate debt can either be call or put option, right? So I told you the limitation also, I told you the advantages also. That is all we have seen in this particular slide. You can see the efficiency, right? In the 2 pages of Macmillan book is just covered in one single slide, every aspect, right? So friends, it takes lots of effort to prepare such kind of content. It require your recognition. It require your, please hit the like button, right? Now friends, let's look at the credit derivative. Very important thing. In just one single slide, you will cover every aspect of credit derivative. Have you ever wondered how bank and financial institution manage credit risk without actually selling the loan? Yes, they manage the credit risk without actually selling the loan. The credit derivative make it possible. These financial instruments allow risks to be transferred. So see what is happening here, that just wait a minute. So what is happening, that risk is transferred from one person to another, right? Ensuring better capital efficiency. But are they risk free? Let's see. So first of all, let's look at the definition, right? What is credit derivative? See, credit derivative are like financial contract, right? That help institution transfer. It help institution transfer credit risk, right, from one entity to another without selling the underlying asset. We don't need to sell the underlying asset, but what we are doing, we are transferring credit risk from one entity to the other without selling the underlying risk, right? That is the definition of credit derivative. Again I am repeating, you are transferring risk from one entity to the another without selling the entity underlying asset. You are not selling the asset, but rather you are transferring risk from one entity to the other. Now, what are the benefits of credit derivative? The first is it diversify your credit risk, that it reduce the exposure to the single borrower. Second is efficient capital utilization, which means bank can lend more while keeping risk control. The third is transferable instrument. So these contracts can be traded in the market. The fourth is governed by ISDA master agreement. ISDA?
International Service Derivative Association. So so basically it is ensured that standardization and legal framework. So this ISDA master agreement ensured standardization. Two things it ensured: standardization, and the second thing is legal framework. These things are ensured by this ISDA. So these are the specific benefits of this credit derivative. Now if you look at the key instruments which are used here, what are some key instruments? The first is CDS, that is called credit default swap. So what happened in this credit default swap? It is a kind of contract where protection seller compensate a protection buyer if a borrower default. If a borrower default, then seller will compensate the buyer. And the second instrument we have is credit linked certificate, which means a security where returns are linked to the credit risk. So friends, how do credit derivative work? If you look at the mechanism here you can see the mechanism. What happened in this case, protection seller, like insurer, we also call it the insurer. It's just like insurance. So protection seller like insurer guarantee payment in case the borrower default. Suppose borrower default, those who has taken the loan default, right? So suppose borrower default, then protection seller guarantee principal payment. And protection buyer, which is the bank, because bank is buying the protection buyer pays a premium to transfer the risk. Yes, they pay a premium, and if a default really occur, the seller compensates the buyer for the loss. You can think of it like car insurance. You pay a premium, and if accident happen, the insurer cover the damage. That's it. Now, who are the participant in this credit derivative? Let's look at it. The participant. The first participant is the protection buyer, right? That means the bank, the investor, right? They want to hedge against default risk. The second is the protection seller, means insurer, means hedge fund. They take the risk in exchange for premium. Yes, they get the premium and they take the risk. And the third is the reference asset, which means the financial instrument on which the derivative is based, like bond, like loan, on which this particular derivative is based, bond or loan. Now friends, if you look at the dark side, risk exposed during 2008-2009 crisis, credit derivative played a major role in the financial crisis. Here is why. The first one was the negligence in credit assessment. Many institutions blindly relied on derivative without checking borrower quality, right? This was what happened in 2009 crisis. You might know about Lehman Bank crisis, right? In USA, it impacted the entire global world. Then the second reason was the high leverage in the credit derivative. Excessive trading magnified the risk. Crisis escalation. The domino effect led to the collapse of major institutions like Lehman Brothers. The lesson learned is that credit derivatives are powerful tool, but when misused, they can save the entire global economy. So final takeaway is that credit derivative offer huge benefit in managing the risk, but they must be used with caution. Bank and institution need better risk control and transparency to prevent another financial meltdown. So every aspect of credit derivative has been taken care of in this particular slide, right? And please hit the like button so that this video reaches other CAIIB aspirant also. Now friends, let's look at this particular point. Credit derivatives are powerful tool for managing risk, but without proper regulation, they can become a ticking time bomb, right? It can become a time bomb, just like what happened in the 2008-2009. So how does RBI handle this instrument? What is the RBI approach? Let's dive into RBI structured approach to credit derivative. First thing comes is the regulatory framework. In the left hand side, you will see, just wait a minute. In the left side, you will see regulatory framework. You can see. So RBI has set a strict guideline to ensure that credit derivative don't lead to excessive speculation or financial instability, right? So regulatory framework has been put by the RBI. So what are some key regulations? Like market maker eligibility, which means only approved financial institution can trade. Second is the RBI guideline. It defines what is allowed and what is not. Then we have capital adequacy norms. That means it ensures that financial institutions have enough capital to absorb the loss. Because without these rules, reckless trading could lead to another financial crisis. And what is the role of bank here? You can see. Friends, bank and financial institutions plays a key role in credit derivative, but not just any bank can participate. See who can participate. Bank and primary dealer, they can participate. A strong NBFC, they can participate. NBFC, non-banking financial institution, RBI approved institution, they can participate. And insurer and mutual fund, right? Only if permitted by regulator. If regulator permit them, then they can participate, right? So these are the market participants in the credit derivative. You must note it down, right? So mutual fund, insurer, they can also participate, but regulator permission is required, right? The idea is that only well-regulated player can participate, ensuring market stability. Now friends, if you look at the eligible entity, so who can use credit derivative? Market maker, they provide liquidity and pricing. There are users who hedge their risk, and the bank and trading book. Financial institution that engage in trading and hedging activity.
And what is the RBI cautious approach? That unlike some global market, RBI does not allow unchecked trading of credit derivative. Why? Because there is something called controlled risk exposure. It prevents excessive risk taking, right? And it avoids systemic crisis. So there is something called single name CDS. Single name CDS means risk transfer with a focus. One of the key credit derivative product is India is the single name CDS, that is called single name credit default swap. What it is used for? It is used for corporate bond, means hedging against the default. It is used for the risk transfer, which means allow investor to shift credit risk efficiently. So RBI has carefully structured the credit derivative market to ensure stability, to ensure risk management, to ensure limited exposure. Right. So friends, that is all you need to learn from this particular chapter, nothing more. Right. Please go through this once more, and then I request you to please solve the MCQs and case study and quizzes which I have added in today's folder. It will hardly take 1 to 2 hours of your time to cover it. Obviously 1 hour is more than sufficient, because there is hardly any numerical in this particular chapter. There is understanding what is repricing risk, what are the use of derivative, how derivative are uses, what is arbitrage, everything aspect like that.